The secrets of value investing you need to know. Discover powerful techniques used by elite successful investors and learn the complete guide to build wealth in the long term and achieve financial freedom faster and effortless. Written by J.D. Rams. Narrated by Mark Wheeler. From the author. Hi, thank you very much for checking out my book. J.D. Rams here, a licensed mechanical engineer and a former university instructor with experience designing robotics machines used in a manufacturing company based in Japan. In 2004, I read a couple of books about the stock market and real estate and started investing in the following year. Thanks to God, I'm still here, had the chance to share my most fantastic experience in investing, which is one of the most excellent strategies of all time that will make you more money in the long run while you sleep. I have written this book and founded The Smart Investor to help investors develop their potential and teach them how to invest in the stock market the right way in the shortest possible time, which I acquired through years of experience. You don't have to learn it the hard way. To develop your full potential, please scan the barcode and join our community where you'll learn further, increase your knowledge, and get the latest update in the U.S. stock market. On our Facebook page, you can ask any questions, and we won't hesitate to answer them satisfactorily. Good luck and happy trading. A gift just for you. Thank you very much for purchasing my book. As a sign of appreciation, I have a gift just for you to accompany this book. These will help you start investing in stock market and guide you the smart way. So go ahead and get it. Good luck and God bless you. Please click the link below or scan the QR code to confirm and claim your bonus e-books. Gift 1, how to get the most out of your stock options as a beginner. Gift 2, your guide to stock investing. So, what are you waiting for? Let's get to it. Introduction. All intelligent investing is value investing, acquiring more than you are paying for. You must value the business in order to value the stock. Charlie Munger. Brian was a 17-year-old boy who always dreamed of having a fancy car, a big house, going around the world, and harnessing every luxury a man could ever think of. However, he was from a middle-class family, and his dreams were far away. He set out on a journey to advance his skills and learn everything that he could about making exponential wealth. He learned many things along the way, but one of the greatest lessons he ever learned was how to invest his money in order to have more. He was easily able to foresee that his enormous dreams could only be realized if he earns money even when he's not putting in the labor. There are only 24 hours a day, and there is only so much you could do with it. He quickly adapted to the fact that in this modern world, there are various available methods to command his money to work for him. It was the simple principle of investing. Brian implied the essence of value investing, and within a span of years before even turning 30, he earned the life of his choice. He created options for himself, and long story short, his dreams were turned into concrete reality. Let me help you imagine the power it holds and how it will enable you to always have money at your disposal, regardless of inflation, pandemic, or even an apocalypse. This book is dedicated to teaching you the greatest skill a man could ever learn in his life, how to invest. And I'm not just speaking of regular investing. I'm inviting you to learn one of the highest levels of it, value investing. That's what this book is all about. I know you may have heard it before, or maybe you haven't, but that's all right. You have the opportunity to learn what value investing is, how it works, and how it will unlock your greatest lifestyle, where money will not be the barrier between you and the things you care about. It doesn't matter at what stage of life you are currently at. You may be investing for a while, a beginner, or even if you're willing to take the initial step. In any case, this book is the catalyst towards providing you the life of your choice. And just like Brian, you could have the lavish lifestyle, or at least not worry about the bills anymore, and do what you truly love. At this point, you may be wondering who I am and why you would learn it from me, correct? I got you. Let me disclose my identity and introduce myself. My name is Joel Ramos, and I've been committed to value investing for years. There were many failures, setbacks, and obstacles in the path, but eventually I cracked the code and learned as much as I could about value investing, its fundamentals, and earned a hefty fortune out of it. It was time for me to impart my wisdom and help other people to achieve mass financial success. In this book, I am not only teaching you how to invest, but I'm also teaching you how to live a life of your choice. It is only fair that I proffer you a slight peek into the book, just so you know what to expect out of it. Here's a short overview you will learn. The rudiments of stocks along with the different available types. The ultimate guide to value investing and also the strategies involved to help you thrive. How to begin investing in stocks. Different formulas that work in conjunction with your investing strategies. The 6 indicators of value stocks. How to analyze a stock's performance. Stock metrics and valuation. How to buy and sell stocks without inflicting major damage upon your portfolio. Value investing principles and screening guide. Tips and techniques from the greatest investing giants, and so much more. It is only the tip of an iceberg. When you dive in, you will find golden nuggets within each chapter that will enhance your capabilities to make better decisions and earn bigger profits. Price is what you pay. Value is what you get. Warren Buffett. A quote from one of the biggest investment tycoons, Warren Buffett. Value is what you should all be seeking. People trade for pennies and get a huge smile when they turn $5 into $7. But that is not the true value. When you are investing for value, you look for far more calculations and you are trying to win big. This book will teach you how to gain that mindset. While we are on that subject, there are 2 requisites if you are ever hoping to gain a fighting chance. What happens to a fighter in a match who is unprepared? That's right, a knockout. You are in this for the long term. And without these 2 things, you won't last. The first is a mindset, and the second one is the knowledge of leveraging compound. Make sure that you imprint these 2 things in your mind. Mindset and compounding. I may not know the exact specifics for all the shares Warren Buffett may have traded since 1941. But I could tell you this, he had the mindset of an investor, and he understood the miracle of compounding. Today, you're going to learn it too. In 20 years from now, you'll thank me for the fortune you will have, provided you execute the strategies well and do not give up on the highway. When I speak of an appropriate mindset, I mean that you need a thicker skin that couldn't be crawled by inflation or bankruptcy or any other losses. I want you to have the mindset of an investor, one who is willing to reconcile with calculated risks, learn the pros and cons, and never gives up no matter how difficult the situation gets. You need an unwavering mindset that will act as a shield to prevent you from making rash decisions. One that will be your biggest asset and let you think on a long-term basis. That's the attitude of a winner. Martial artist Rickson Gracie said, "A strong body is a good asset. A strong mind is a very good asset. Have it." Rickson Gracie. That takes us to the second most important principle, which is compounding. Do you know why millions of people are aware of stocks and investments, but only a handful succeed. Because they do not understand what compounding is, and they never use it in their entire life. I was blown away the day I came across this concept, and since then, my whole life took a major shift. The pure essence of compounding is to do nothing. Do you know how difficult it is for people to do nothing? Most people panic and take a detour. This costs them a fortune. In simple terms, compounding means that you invest an amount into a particular stock or a fund and let it sit there for a decade or two. Is it too difficult? Let me explain to you with numbers. If you invest $10,000 today in an index fund that runs at a 15% return, you will have approximately $43,604 after 10 years. After 20 years, you'll have $190,129. And guess how much it will be after 30 years? $829,035. It's the same $10,000, which would have been worthless than half if kept in a savings account due to depreciation. But since you were smart enough to invest it, there is a profit waiting for you. What will happen if you invest 20 or 50 or 100,000? I'll let you be the judge of it. That is the mighty power of compounding. Even Albert Einstein referred to it as the eighth wonder of the world. This tool is now at your disposal to use at any time you wish. Knock yourself out and live the life of your choice. This book is going to change it with leaps and bounds. A short disclaimer, though. It is not a get-rich-quick scheme that will make you money in the short run just by reading it. If you are holding on to that perspective, then get over it now. This book is designed to make you wealthy and keep you there. Only if you promise me that you will execute the lessons and principles outlined. Otherwise, it will be just another book that you read once and decorated on your shelf. Do I have your word? Great. Let's get started. The core. Foundations of building wealth. The stock market really isn't a gamble, as long as you pick good companies that you think will do well, and not just because of the stock price. Peter Lynch. Have you ever wondered how multi-billion-dollar companies like McDonald's, Tesla, Starbucks, Apple, Amazon, Facebook, Google, and many more grow so quickly to enter their ranks? What if I tell you that they did it because of you? Would you agree with me? Of course, you bought their products for a long time, but that's not all. They even took your money to grow into who they are today. You look interested. Let me show you how. They had a definite plan to grow their business, but they didn't have the money, or even if they did, they didn't want to use it and save it for rainy days. Therefore, to get the money for expansion without going to banks and getting further into debt, they provided you a great opportunity to invest in their company. Where do they do it from? It's a place called stock market, a collection of all issued companies where people from all walks of life and all levels, from beginners to professionals, could buy and sell stocks in exchange for money. The piece of the company which they offer you in exchange for your money is called a stock, share, or equity. Now, what does it mean to buy a stock? Okay, they grow the business, so what is in it for you? The founders and investors put their money into a company with the hopes of seeing that company grow, get their money back, and potentially gain a hefty return on their investment. In short, they are being entitled to an owner of that company. What it means is that you are buying a tiny piece of ownership in that company by buying their shares and stocks. The motive is bigger than that. Sure, you want to multiply your money, but investing in a company accomplishes other objectives too. For instance, you are not only contributing towards the growth of a company, people are getting employment because of that company, and it is helping the economy of the country to rise as well. Your money is not only making you wealthy, it is making your country a better place to live. After you buy the stocks, the company will use your money to execute their super special plan of expansion, And in return, they are giving you a definite portion of whatever they make for the rest of your life. Pretty amazing, isn't it? For instance, let's say you invested $500 in a company, and after 3 years, they doubled the company's revenue and hence profit. Therefore, the $500 you invested will then be worth $1,000. You just doubled the money without breaking a sweat. Cool. What would have happened to that $500 if you were to keep it in your bank account? You would have either spent it all on food and shopping, gaining a small amount of interest, which is practically negligible, or the inflation would have decreased the worth of your money. In any case, you wouldn't have the $500 you worked so hard to earn. Investing your cash is the best way to secure your future and the ones you love. That's what this book is about, to share with you the art of investing, so that the money you earn today could help you tomorrow when you need it the most. Furthermore, people have developed a practical solution to earn cash with cash. They invest their money by buying a few stocks of a company at a particular rate and sell them at a comparatively higher price to gain profit. For example, when you buy 10 stocks for $100, $10 each, and after a while, when the price of the stock increases by $2 and you decide to sell it, you make a profit of $20. The more stocks you buy, the bigger chunk of the company you get. That's how the market works, and it is the overview of the stock buying and selling phenomenon. It's called trading. Some of the platforms or marketplaces where the rolling occurs, including the New York Stock Exchange, NASDAQ, etc. Some of these marketplaces also allow you to trade financial securities, like bonds and funds. Functions of a stock market. Among the functions of the stock market, one of the vital ones is to provide fair transparency and data to each trader and investor. Therefore, you gain necessary data about the company's stock, its history, current true pricing, and a strategic, well-planned future. You can make your decision of investment based on these factors. For example, there could be a company, who did horribly in the past 3 years. However, they readjusted their strategy, clarified their end goal, and brought themselves back on track. The given data showcases a change with time and current success. It is up to you to predict whether Company A is going to be any success. What do you think? If you don't have instant access to any important data that could help you make a decision, there is something wrong with the marketplace you're trading in. Take your money and run as fast as you can. Only trade in the most trusted marketplaces available as mentioned earlier. Here are a few more functions of a stock market. There must be an efficient system to decide the price of a stock in which people are going to trade. A comprehensive assessment of the market supply is conducted so that you as a trader or investor get the benefit of the actual price of the stock at that moment. Every time you wish to trade, you should be given instant access to placing orders. On top of that, they must also be carried away fluently without much confusion. Every marketplace evaluates whether the members are adequately qualified and are following every set rule. In a great marketplace, there is always an added layer of protection for beginners who are unaware of the complete truth and might fall into the serious problem by investing in super risky businesses right from the start. It could be that these new members get a pop-up notification warning them about the risks, or they should be inhibited from dealing in really risky investments. Having a system to take care of their members is actually an assurance. Finally, a marketplace will have a well-balanced ecosystem for every member. May it be a trader, investor, financial speculator, hedger, traders who use financial tools or strategies to overcome the risk involved in the stock price shifts, etc. Here is a bonus function. Marketplace enables the business owners to provide stocks options to their employees to save salaries and also to inspire them to work harder and try to magnify the growth of the company. Types of trading methods. When someone buys the stock and sells them on the same day, it is called day trading, and the person doing it is called a day trader. They typically buy the stock at a lower price at the beginning of the day and then wait for it to rise as much as it can so that they can sell it and make a little profit. I know what you're thinking. The stock price never increases by several $100s in a day. It only hikes by maybe a few pennies or $1 or $2. Sometimes it even goes lower than the bought price. So how do they make a huge profit? Well, when they can't go for the quality, they go for the quantity. Let's go with the example I mentioned earlier. After a hike of $2 in a stock price, it's not a huge profit to make a couple of additional dollars after owning 10 or 20 stocks. But what if you owned 1,000 stocks or 10,000, maybe 100,000? Even a slight increase of $2 could have a dramatic effect on the overall profit when you own as many stocks. However, the same is true when you own even a couple of 1,000 stocks of a company, and it makes a huge profit. The second type of trading is swing trading, and the people who indulge themselves in it are called swing traders. A cheeky name, isn't it? Here, the traders buy a particular stock and hold it in their portfolio, a collection of stocks and other investments, for one or more days, waiting for the stock price to rise so that they can sell them and make a profit. They are looking for short-term or medium-term gains in the marketplace. Fundamental trading is the third type of trading, where the traders try to analyze the individual companies and their situations to decide which stocks to purchase. For instance, suppose they want to invest in a coffee-based company as they know it is growing. They might invest in Starbucks, as it is one of the largest coffee-selling companies in the world. Although, if another company is making its mark on the market, getting hype, then they might invest in it as there is a probability of faster growth in new companies than the established ones. Starbucks may give them stability, but the other company holds the key to outrageous returns with an equal amount of risk involved. We came down to the last type of trading, and it is one of the most rewarding types of all. It needs patience and pure dedication, but the returns are exponential as well. It's called long-term investing. This is where you buy the stock and hold it for a long period. We are talking not in months here, we are talking in years, if not decades. You must know Warren Buffett because he is a walking example of long-term investing. He became a billionaire at the age of 55. How? He invested in companies that gave him the returns over decades. Let's look at Tesla. This electric car company made its debut in the stock market world in 2010, and at that time, the price of the stock was only $17. Today, it is more than $710. Therefore, in 2010, if you would have decided to buy 100 stocks for $1,700 today, you would have more than $1.2 million. I'll let that jaw come back up. I always had faith in the internet. I believed in it and thought it was obviously going to change the way the world worked. I really did not understand why others were selling their stock. As stock prices plunged, I just bought them, one after another. Since I had the money, I guess I was rather lucky. Takafumi Hori. It is crucial to know the stocks you're trading in, as the money you have now is not supposed to be tossed away under pure luck. You need analysis and keen observation, along with the will to choose the companies that enhance your portfolio to proffer you with the chance to make an impact while making you financially independent. Types of stocks. There are various patterns to differentiate the stocks. You need to understand each one of them so that you can make your decision. Allow me to enlighten you regarding the basic stock classification. Type 1. Ownership. It is considered as one of the most basic types of stocks classification basis, and it divides them into three types of stocks, namely common, preferred, and hybrid. Common stocks are the ones that entitle their investors to gain dividends and voting rights. The amount may vary and sometimes could even be skipped, depending on the situation of the company. These are also the last people the company reaches out to during liquidation. Conversely, preferred stocks are the shares of the company that pays out dividends to their shareholders before the issuance of the common stock dividends. It is seen that most preferred stocks have a fixed amount of dividend year in and year out. This is the only difference between a common and preferred stock. It may also appreciate with company's growth. During those times, when the company is distributing the additional money among shareholders, the ones having preferred stocks are usually the top priority. However, they may not have a voting right in the company's decisions. The hybrid stock has a distinct feature. It allows you the opportunity to convert some of your preferred shares into common stocks. Type 2. Market capitalization. The market value of any publicly traded company is called market capitalization. Stocks can be divided based on this factor into the small cap, mid cap, and large cap stocks. Cap is just a smaller version of capitalization. These are straightforward divisions. Small cap stocks are the ones that have the smallest value in the marketplace. Any company that has a market cap between $300 million to $2 billion is considered a small cap company. These are a few types of companies that hold explosive growth potential, and thus investing in them for a long-term basis could make you super rich when done right. It may be difficult to predict their future growth right away, but a keen analysis and data will open doors for you. Small companies can take off at any month, but they can be shoved to the ground as well. The question is, which company do you invest in and how long are you willing to wait? The mid-cap companies are the ones with a market cap range between $2 billion to $10 billion. These are the ones that hold the dual benefit of providing you with a stock that holds great growth potential, along with the low risk factor and stability of a large cap company. It sits right in the middle. You will mostly find steady stocks that are growing gradually in this segment. You'll be glad after investing for a long-term period. The final stock of this type is the large market cap. Any company with a market cap of $10 billion or more is ranked under this section. These are the blue chip stocks that offer serious stability and slower growth rate due to their sheer size, as they have already grown out of their wings and secured a place in the market. However, you do get a higher percentage of dividends when you stick with them over a longer period. Type 3. Dividends. If you aren't willing to sell your shares, the only great way to get paid for those stocks you flaunt your portfolio with is dividends. Based on how much dividends the companies pay, their stocks could be differentiated into income and growth stocks. You must have guessed a few things from the name, but let me explain. Income stock pays you a higher amount of dividend in the market. It means the more dividend they pay, the higher will be your income, thus the name. These are mostly the mid to large capital companies that pay steady dividends to their investors. There is one additional thing that you should consider, and that is the companies that provide the higher amount of dividend are probably the ones with the least growth potential. They are already ruling the major markets and gaining clients. Some people also call it a preferred stock as it pays regular dividends. Hence, if you need another source of income, you need to find companies with income stocks and buy some shares for a long period of time. Now, you may be wondering how to know whether any stock qualifies as an income stock. The answer lies within the dividend yield measure. When you are analyzing the company, look for the percentage. However, if you can't find it, you can always calculate it yourself. All you need to do in the equation is divide the dividend they offer per share with the current market price of the stock and multiply the answer by 100. Voila! For instance, if the price of the stock is $1,000 and they provide a dividend of $5, then your dividend yield is 0.5%. The more, the merrier. The next stock under dividends is the growth stock. You may not always find companies paying high dividends because most of the time, businesses just need to reinvest the profits they made back into the business to gain explosive growth. It enables the company to grow faster and evidently increases the value of their stock, thus the name. You may not earn an income here, but you can definitely get a higher return by selling those stocks. They are riskier than the income stock because anything might go wrong with the growth plan. If the company ceases to exist, it cannot be called a growth stock anymore. Choose wisely. Here are some of the best dividend stocks according to Investopedia. Include Annaly Capital Management, NLY, with a dividend yield of 10.23% and a market cap of $12.4 billion. AGNC Investment Group, AGNC, with a dividend yield of 8.85% and a market cap of $8.5 billion. New Residential Investment Corp., NRZ, with a dividend yield of 8.11% and a market cap of $4.6 billion. Southern Copper Corporation, SCCO, with a dividend yield of 5.74% and a market cap of $48.5 billion. TFS Financial Corporation, TFSL, with a dividend yield of 5.68% and a market cap of $5.5 billion. Let me impart a bonus tip to you about the stock. If its current value in the marketplace is higher than its intrinsic value, true worth of the stock, it is known as an overvalued stock. Conversely, if the price of the stock is lower than its intrinsic value, it's known as an undervalued stock. The first one may break your heart as the big drop of the market might be closer, but the latter is a gold mine, as the chances of you getting a crazy return looks pretty good. This book is designed to help you strike these gold mines and collect as many value stocks for you as possible, because your bright investing future depends on it. More on this one later. Type 4. Risk. Risks are inevitable. Some companies grow and some fall. That's the universal fact. However, it's totally your choice to decide whether the risk you are taking is worth it. Based on the risk parameter, the stocks are divided into blue chip stocks and beta stocks. Blue chip stocks are companies with stability and annual earning. They provide dividends and grow slowly but surely. Conversely, beta stocks impose greater risk as the company might be in its prime with a 50% chance of growth or failure. The stock price might go up or crash down. In any case, people earn millions in this kind of stock when they research well. There are a few stories of people losing millions as well. The beta value should be less. If it is higher than 1, there is a bigger risk involved because of volatility. When buying a stock, you should consider all parameters: size of the company, their dividend payout history, the industry they're committing to, the risk involved, their plans for the future, etc. Only then you should make a decision. Do not treat it like a gambling fling. It's a serious game with the price of financial freedom. Let's revert to the growth stocks, aka value stocks. As you already know, a value stock is one that is trading for a lower value than its actual worth. For example, the true value of the stock could be $15 per share, while it's being traded for $10 or lower. You might not see the literal value with a difference in a couple of bucks, but when the quantities or large number of shares increase, it makes a huge impact on your overall portfolio and earnings. There is a reason why sophisticated investors work day and night to get their hands on value stock. Basically, when you know that the company is performing admirably in the market and still the price of the stock hasn't gone up yet, these are the stocks you are craving for. You can know which ones are the value stocks by looking at their low PE ratio, price to earnings, PB ratio, price to book, and high dividend yield percentage. These stocks are often considered riskier as the market isn't fully clear about them and their development. However, it is mostly seen that in the long run, a value stock pays off big time. Some of the best growth stocks include FITB, BSX, IPG, ETSY, ZM, BLDR, TSLA, etc. That, my friend, covers up the basic foundation of investing. In the next chapter, we will dive deep into the complete guide of value investing with specific strategies and tips to make the best decisions. Are you ready? Let's proceed. Building Long-Term Success: Ultimate Guide to Successful Investing. All intelligent investing is value investing, acquiring more than you are paying for. You must value the business in order to value the stock. Charlie Munger. Value investing is the core foundation of attaining success in the stock market world. Everything you do is supposed to reflect not in days, but years. That's the absolute way to build wealth. What comes faster goes faster. You had a sneak peek into the value investing phenomenon. In this chapter, you will learn exactly what it is and how you could use it to your advantage. You already know that picking up the stocks that are trading for a lesser amount than their actual intrinsic value is referred to as value investing. There's a massive opportunity that comes post-holding the picked stocks for a significant period. The price will eventually rise, and that's your huge return. There are often stocks that are underestimated by the market. Your job is to find those golden nuggets and add them to your collection, and just let the time cast its spell. Therefore, for this strategy to comprehensively work in your favor, you need to have complete knowledge of the company and the industry you're trading in. Knowing the company's fundamental status and vision could help you make a better decision. As far as people are concerned, they always have an installed fear factor that results in them overreacting to any news, whether good or bad. You tell them that the company is going to a downfall, they will panic and start selling their stocks in hope of keeping their losses to a minimum. Conversely, when you tell them that a particular company is rising, they will find it and buy as many stocks as possible, hoping to receive a reward. These sudden actions cause fluctuations in the market, and the price of the stocks move from high to low and vice versa. During the chaos, there is always a window opening for those who keep their cool and have a distant vision rather than a puny, short-term sight. That's why if you believe in a company that currently may seem to cut their stock prices down in order to grow, albeit other people might be selling their shares, but you will be happily buying them at a lower price. Throughout history, there have been many people standing on the pinnacle of the value investing paradigm, namely Warren Buffett, one of the best-known examples, Benjamin Graham, he was Warren Buffett's mentor, and many more. Most people still confuse this simple strategy of value investing. Hence, let me clear your conundrum so you can think straight. Suppose there's a village on a mountain that's cut off from the main city. People there have no connection with others. They did find an actual gold mine under a cave and started selling it to city people who passed through the only highway attached to the forest. Now, at this point, if a person walks into the village and spreads a piece of news that the gold they've been mining and selling to the city people is going down in price and it could affect their livelihood, will they all panic and mine as much gold as they can and sell it for a lesser price than usual to pile up their livestock and continue living? The man who started the news will take all the gold for a very cheap price and then travel to the city to sell every last gram of gold he obtained for a double rate than what he initially paid for. Or he will wait until the price of gold skyrockets to sell it and gain triple or quadruple times return. In this story, the villagers are the normal traders or investors who trade daily and earn a little bit of return or sometimes suffer a loss. The gold is the stock that they buy, and the city is the marketplace they should be selling it to. The man who spreads the news is a value investor because he knows that the price of gold never goes down dramatically, and even if it does, it always goes up eventually. He will save a lot of money during this mayhem. Therefore, sticking to this thesis, he purchases all the gold, stocks, from the villagers, traders, and sells it instantly for a higher return on his investment. There will be other people who will hear the news and think like a value investor and purchase all the gold they can and rush to the city to sell or wait. There's a quote befitting this topic. We simply attempt to be fearful when others are greedy and to be greedy only when others are fearful. Warren Buffett. A great value investor will switch on the detective mode and find stock that is currently underappreciated by the market, but holds a tremendous potential to grow in the near future. The result will be a handsome return. The stock price is what people are focusing, and this is causing them money. Sometimes the price of the stock changes, even if the company is experiencing stability. So there are many other factors to consider other than the stock price itself. What are these factors? I'm glad you asked. Value investors use a combination of metrics to figure out the true value of a company's stock and its future possibilities. Then compare it with the current market price to check whether the price is overestimated or underestimated. The factors appear in the financial analysis report. You must know the company's financial performance, debt, assets, revenue, profits, cash flow, investors, vision, brand, need in the marketplace, a competitive advantage over their rivals, etc. Having these values will proffer you an abstract view over any company to determine whether the stock is worth buying or not. You can gain a company's earnings through its P/E ratio, price to earnings, its cash flow, and assets through its P/B ratio, price to booking, cash flow report, etc. Now, a question may appear in your brain. Where can I gain all this information from? From the company itself. Companies provide their annual reports and 10K reports for you to refer to, which are free of charge. You can quickly go to the company's website and you will find the reports. If you don't find it there, you can simply search Annual Report of fill in the blank company, and you will get a download link which you can then utilize in any way you want. If all companies are having positive values in the factors stated above, you know it is running well. Companies publish their 10K reports every year stating their performance. You can also download the 10Q report from a company from searching it on the internet and get your hands on their quarterly performance. You will find many other values and charts in these reports, but focus on only the major metrics and you'll be just fine. Nevertheless, do you think that you will always hit the bullseye with your value estimation? Not at all. There will be a few errors, and you will have to be prepared for them by trading in the room of safety. This is why value investing is really amazing, because let's say the price of the stock is $200 and you bought it for only $150 during the cross-selling. Then if the company just rises back to its original price of $200, you will still gain a profit of $50. In case you were right about the company's vision and success in the long run, the return will be exponential. For instance, if the stock price grows to $210, people who bought it for its true value, which is $200, will only gain $10, while a value investor like yourself will gain a profit of $60. That's big. You will have nothing to lose unless the company hits rock bottom and perishes from the map. That won't happen because you will commit to thorough research before investing in any company. During the pandemic, the stock market was doing badly due to a poor economy, and that caused the stock prices to fall. However, that isn't the true value of the stock. It is just one of the factors affecting the price of the stock, other than the company itself. There are many more as well. That's why I personally recommend you not to put all your faith in the stock price and do your own research. Like the story of the gold, people might be panicking for their livelihood and selling stocks, resulting in the price drop. However, it's your chance to swoop in and take all for yourself. Never do what all the other people are doing. Stay away from a herd mentality and forge your own path toward success. If everyone is buying out of fame and curiosity, be fearful and think about selling or holding up for a long term, because there's a good chance the stock might fall soon. And on the other hand, if everyone is selling due to any news, and you know according to your research that the company has the potential and a strong foundational value, start buying at a discounted rate and wait for it. It is often witnessed that the companies with a big buzz in the media gain stock traction for a while. But you don't always have to invest in any company that is growing. Sure, people make money and become rich following the buzz, but do not add just any company to your precious portfolio and treat it as an extension of what you believe in. If you care about the environment, do not trade in companies that spread garbage and increase pollution, no matter how fancy the return is. Stick with companies that align with your values and use biodegradable products and ingredients, or are fighting against the devil companies. Other people's opinions are invalid unless you have clarity of who you are and what you want from your money. Stick with your philosophy diligently, and you will be far happier. Factors undervaluing the stock prices. When you're looking for undervalued stocks, it is natural to know what makes those stocks lose their value in the marketplace. Discerning those factors could help you find them quicker and invest. Here are a few of them. Number 1, the herd mentality. There is a trend running on social media where viewers are told, if you would have invested $1,000 in this stock 12 months before, you would now have $2,000, something like that. And this creates a sense of fear that they might miss out on another double in the next 12 months. This causes them to invest, and they share it with their peers who follow the same mentality, causing kind of a ripple effect. The same thing happens when someone tells you about a stock falling down. You start selling that stock and convince your peers to do the same. It moves the market towards that stock, and thus a shift occurs. This is such a normal chain, and it is mostly seen that regardless of the company or any other major factor, people shift from one stock to another. It is a dangerous place to find yourself in. Major crashes. Sometimes the herd mentality becomes furious, and so many people sell off their stocks due to fear or greed that it causes the market to crash, thus resulting in undervalued stocks. However, there are other causes for the market to crash as well, such as economical, pandemic, war, etc. You must have heard about the dot-com bubble and housing bubble, haven't you? New stocks. Companies are emerging every day, and there could be many unnoticed stocks in the market. People always go for the trending one and lose sight of other fish in the ocean, like small cap companies or even foreign stocks. Being a value investor, it is your duty to find those potential stocks and invest in them. When people find the next big thing, they migrate to that, and therefore damaging the previous stock's price. Blundered news. Do you recall the story I told you before? The gold was given away at a very cheap price because they heard bad news and believed it without conducting any research. It cost them too much gold for a very little price. The same happens when traders and investors come across any news. They panic and sell away every last piece of shares to reduce their losses. Companies always go from ups and down. It doesn't mean that it is going to die. It could be, but after you've conducted research, the company can surely bounce back and rise to the top. If people are selling it, go crazy and buy them at a discounted price. You must believe in your findings and stay put during such times to always win big. These factors may cause havoc in the marketplace, but stay calm and trust your judgment and believe in your research that the company will do good in the long run while bringing healthy returns. Use value investing as a concrete strategy to buy cheap and sell incredibly. During my years of research, I stumbled upon a myth-breaking discovery that changed the way I invested forever. I believe that if anyone who wishes to become a value investor needs to follow this no questions asked. The social media, news, peers, stock price, and everything else are greatly inaccurate. The only absolute form of true information is the company's financials, reports, balance sheet, income statement, and any other financial data. This is what most sophisticated investors believe in. I also follow the unique approach of Warren Buffett and his mentor Benjamin Graham, one of the two legends who changed the world of stock market investing. Graham used a simple technique which enabled an investor to discern the stock's ability to generate cash. If it can't make money, it's not worth buying. Graham, being a value investor, always chased the stocks that could pay the most dividends and generate cash consistently year in and year out. He taught the same method to Buffett as well. However, Buffett developed his own ideology by attaching a new module to this simple technique. According to Buffett, he only invests in the company that he truly believes to be good in the long run. He thinks in terms of decades, not months. Even if he has to pay a little premium in the beginning, it is fine until the long-term return is incredible. That's the reason he wasn't super rich until his late 40s. The slow and steady rule is what made him one of the top richest men in the world. In addition to that, Buffett always preaches to have a huge amount of cash in hand for every opportunity that might reveal itself. Not being able to take a good advantage of such tremendous ones could cost you a fortune. His company, Berkshire Hathaway, I think you must have heard about it, cracked the headline for simply accumulating $122.38 billion in cash. Why? So that they can invest heavily into any upcoming company that showcases immense growth potential. I previously spoke about staying in a safety room, didn't I? The best way to do that while using value investing as a strategy is to indulge in a method called diversification. Value investing is one of the greatest ones out there. However, we are all human and we could commit an error, or there might be an unpredictable phenomenon that could take the company down. Therefore, to really stay in the safety room, you need to diversify your portfolio. If you have invested in one company from a particular industry, then find another from the same industry, a rival probably, or if the one you choose is the best, then move to a new industry and pick up more value stocks. In that way, even if something bad happens, you won't be entirely ripped off. You can diversify between companies that generate dividends and the companies that focus on growth. This way, you will keep getting paid for the stock you own. I suggest that you buy multiple value stocks from various industries to gain a strong cash flow. Moving forward, the benefits that value investing provide are exquisite. If you've picked the right value stock, you know that you will gain success in the long term. It is proven by Buffett and anyone who followed his philosophy of investing. If you observe closely at the stock market over a period of 20 years, the stocks have always gone up. That's the beauty of it. If you have the required patience, the simplicity which values investing provides astonishes you. The cash flow through dividends and other modes of diversification is a reward to humankind. I may have to stop your imagination for a little while and explain to you that you may be falling into a big trap of value investment. What is it? You see, during the value stock hunt, You may often stumble upon a few stocks that look like a fantastic investment on paper, but in reality, it may be closer to their demise. In order to recognize these traps, you need to focus on the company's revenue and cash flow. If the company has great cash flow, by Graham's rule, you will believe that it is a great value stock and may end up buying it. However, check on the revenue of the company as well. If the cash flow is increasing, but the revenue is shrinking with time, then there is a huge problem. People aren't interested in buying their products and services, and hence their sales are suffering. You do not want to get stuck with such a company. They will soon run out of cash and collapse. Avoid the value trap, and you will sleep soundly at night, knowing that the stocks you picked are going to fulfill your wishes. Par value versus no par value. The stock of any company will have one of the two values, par value or no par value. But what does it mean? These values have no significance to the value of the stock price. The par value is also known as face value, is the value of every individual stock assigned to it by the company itself. The companies mostly choose a lower par value for their stock, like 1 cent or so. Conversely, a no par value of the stock means that the individual share or stock is publicized without any minimum value. For instance, if the company needs to raise $100,000 through their shares, they will introduce a par value of $1 for 100,000 individual stocks, thus resulting in the total amount they will generate. On any occasion, if the stock price falls below the par value, then the company is liable to provide its shareholders the difference of the fall. Issuing a no-par stock means that the company hasn't assigned any minimum value to the stock. I think you are now ready to begin your journey as a value investor. And thus, I will take you to the beginning stage and guide you through the basics so that you can start value investing and secure your future gaining by financial freedom. The next chapter will guide you how to invest and teach you the tips and strategies you might need in the process. It also contains a magic formula, so stay on track and you will find it. Let's move. Achieving Financial Independence. Building Wealth the Simple and Easy Way. The intelligent investor should recognize that market panics can create great prices for good companies and good prices for great companies. Benjamin Graham. Beginning your stock investing career is as simple as it could be. Most people try to complicate things by telling you various rules and regulations that might never come in handy. In this chapter, I will introduce the simplest way to get started with investing and also provide you some handy strategies that professionals use to gain a cutting edge in the marketplace. Without further ado, let's get started. The rise of the fintech industry in today's world has made investing accessible to everyone who has a smartphone and has an internet connection. With those tools, you can start investing today. Download the app of your respective brokerage fund, open an account, deposit some money into it, and start trading, my friend. That's it. As we already spoke in the previous chapters, owning a share of stock of a company makes you a part owner in the business. You will be granted common shareholder rank, and thus, when the company pays out dividends, it will be the amount per share. You also receive voting rights. As a beginner, you must be aware that there are only two ways to earn money in the stock market. The first way is to buy stocks and earn dividends on each one of them, and the second way is to sell the stocks for a higher price than you originally purchased it. Before we proceed, I would like to teach you a very important topic. It's called compounding. As an investor in any asset, you must know the value of compounding. This is such a miraculous phenomenon that even Albert Einstein referred to it as the eighth wonder of the world. If you don't already know it, then here is what it means. The returns you gain on any particular investment increases over time. For instance, if you invest $100 in a stock portfolio and hold it for, let's say, 5 years at a conservative 14% of annual return, you will have $199 at the end of 5 years. However, if you keep that money for a longer period, let's say 10, 20, or even 30 years, then you will have 396, 1,568, or 6,206, respectively. Let that sink in. $100 turned to more than $6,000 without doing anything. That's what you get to utilize the magic of compounding. The paramount key here is the time. Hence, the sooner you start, the richer you will be. This is what Warren Buffett used to become the richest investor in our generation. Important questions you need to know about investing. I can understand that you may be having a ton of questions regarding this. Let's solve your doubts so that you can have a clear idea about investing. Question 1. Where should you start investing? There is an easy method to get started. You must be above 18 years old to have your own brokerage account. If not, then you can still open the account with your parents' or guardian's name, and when you cross 18, you can transfer it to your name. Have a separate bank account for trading purposes. Once you're done, you can have a standard brokerage account that will allow you to trade in all kinds of investments like ETFs, stocks, mutual funds, etc. Standard brokerage account has multiple sub-options to choose from. You should begin with a cash account, which simply means that you can link your bank account to your brokerage account and use the money in it to trade. Stay away from offline brokers because they charge you extra money for every trade you make. Multiple online brokerage platforms are easy to use and keep more money in your pocket, such as Webull, Ameritrade, Charles Schwab, E-Trade, Ally Invest, etc. Find more if you can and use these services instead. They may or may not charge you a small fee, but it is way lower than what direct offline brokers charge. After you have figured out the suitable service, you should fund your brokerage account with a small amount and use that to buy stocks of the company you previously studied and are interested in. There could be errors and you might lose money. Therefore, start small and test the waters first. Use the amount you are comfortable losing, and once you get the hang of it, go wild. However, keep in account your risk tolerance. Initially, you might lose a little bit of money, but over the long run, the market always goes up. Question 2. What is the accurate amount you should start with? This is a big question for most beginners. As mentioned before, the amount should be small and yet good enough to get the stock of your choice. You can start with $100 and work your way up to $1,000 or more. For the record, there are stocks that could be worth $5 as well. So there isn't any lower limit on your initial investment. Question 3. Which investing strategy should you use to surely become rich? I will tell you this loud and clear. Value investing. It is one of the greatest strategies of all time that will definitely make you more money in the long run. Find those valued stocks, buy them, and look out for a wave of money. When combined with the magic of compounding, you will make more money while you sleep. Question 4. Should you invest on your own or seek help? There is another option for people who aren't good at studying the company's metrics. However, you should, and I highly recommend you to know how to do it yourself as an investor. But you can skip it if you don't have the time to sit and study companies. You can take the help of a financial advisor or a robo-advisor. A financial advisor is simply someone who has knowledge of the businesses and is doing it for years. You can hire one and ask them about which investments to pick. It is a pretty standard practice which many people use, but they also charge you more money for their services. It isn't for you when you are just beginning. That brings us to the next type of help, which is robo-advisors. It is an online platform where a group of financial advisors suggests the method of investing. You do not have to meet anyone or talk to anyone about this matter. All of your needs will be looked after without or minimum human intervention. It's basically an algorithm that is designed to help you pick the best stocks and succeed in investing. They charge less, approximately 0.25% of your total portfolio, give or take. But it is very beneficial to those who are just beginning. It is, as Warren Buffett said, investing is simple but not easy. Warren Buffett. Question 5. Which type of stocks to pick as a beginner? It is often difficult for newbies to clash their excitement with a false errand that could backfire. Knowing which one of the stocks to pick is the key to success. To be in the safe zone, you can definitely pick the blue chip stocks. They are the companies that are already established in the market, like Apple, Amazon, Tesla, Berkshire Hathaway, etc., or any other consistent dividend-yielding stocks. The key here is to know which stocks will help you gain the maximum returns over time. Blue chip stocks do have the stability and authority, plus they are wrestling to grow even bigger, which is again an opportunity for you to gain more bucks. On the other hand, dividend-yielding stocks will suffice you with a fixed salary every month, quarter, or year. You can simply Google the best blue chip stocks and the list will pop on your screen. There you go. Invest. I have a magic formula for you that explains in detail about this topic. Wait for it in the upcoming section. Question 6. What are the different types of stocks? As a beginner, you are only required to know 3 major types of stocks that you can invest in. They are as follows. Individual stocks. It means that you choose and pick individual stocks as you see fit. You like Netflix, buy their shares. You like Apple, buy some stocks. That's how it works. Pretty straightforward. There are maximum chances of you hitting a home run with this technique. Any stocks could take off as Facebook or Tesla did. However, the other way around is true as well. The risk is also at 50%. Mutual fund. It is a collective place for multiple stocks. If you only invest in a mutual fund or any other fund, it means that you are diversifying your money into various stocks that are actively managed by professionals. There is a fund manager who will choose the best stocks according to them and based on serious research that could outperform the market and give their investors some pretty serious returns. If any stock doesn't perform adequately, they replace it. Exchange-traded funds. These are similar to the mutual funds as explained above. However, the only point of difference is that ETFs aren't actively managed. These are also called index funds because they heavily invest in different market indexes. I am sure you may have heard about the S&P 500 or the Russell 2000. They charge lesser than the mutual funds and work best for long-term investors. If you're looking to accurately diversify your portfolio, it is better to start investing in an ETF from the start. New investors jump over classic ETFs because of their long-term performance. 9 hardcore tips. There are a few tips I could give you regarding this matter and will definitely come in handy during your investing. You already know that you must research well about the stocks you are willing to purchase. So let me guide you through it. 1. Look for a return growth. What I mean by that is that during the research phase, find stocks that showcase an enhanced trend in the near future. For instance, robotics is the future, and we are already living it. So it is a trend that is going to stay for a long time. Stay away from fluke trends that hit big for a period of time and then perish like a hot fidget spinner. Regardless of how small the progress is, as long as it is positive, you are good to go. Number 2, invest only in the companies that you truly like and know that they could make an impact on people's lives. This is a very powerful tip because if you like what the company culture stands for, what their vision is, and where they are headed, you will definitely stick with them over a long period, even if things aren't in their favor for a short while. Number 3, think in terms of decades, not months or a couple of years. It is endearing to see a quick buck hit your bank account, but waiting could give you a briefcase full of cash. Number 4, be optimistic, but also be open to pitfalls and harsh decisions. Keep your mindset straight as you'll be needing it on various occasions. Number 5, discern if the company is worth investing in by looking at its future growth potential. If a new company is promising enough to make a fabulous debut and is firm enough to endure the market with constant growth, it is a dream stock that you must have in your portfolio. As questions like, does this company stand out from the crowd? Is there a future for the products they sell? Are people going to spend money on this company after 10 or 20 years? The answer will speak for itself. Number 6, what is the dividend ratio of the company? How much dividend do they share with their investors is a key analysis about the stock's current status. Number 7, analyze the financial reports of the company to gain a comprehensive perspective about them. Number 8, if a lot of management members of the company or an investor who owns more than 10% of the stocks, also called an insider, are buying the stocks, it means the conditions look favorable and there is a scope for growth and returns. You must also buy more during such times. On the contrary, if those insiders are selling all their stock of the company, then it might mean that a huge fall is awaiting. You should be cautious and sell your stocks immediately before the hit takes place. Do not fright if only a couple of members sell them, because there may be other reasons for them to do so. A need, or cash, or a bigger opportunity, who knows? Number 9, check out the leadership or board membership of the company. Who sits on the throne or the leading team is vital, as their vision about the company and their attitude are important to make a decision. If he or she is only going to flip company to someone else or decide to make it successful themselves, is inherently going to affect your judgment. Great companies like Apple and Tesla wouldn't exist without the thorough contribution from Steve Jobs and Elon Musk. They built it to last. Another concept most people have trouble getting used to is selling stocks. There is a time to hold on to them, and there is a time to discard them from your portfolio and bring in a new set. Conducting due diligence is extremely important to avoid fatal loss. On the path to becoming a savvy investor, you need to know this. Always be optimistic, but know that bad things could happen, and companies may fall from the sky to the ground. Be open to drastic news and prepare yourself to stay calm. That is the best way to make accurate decisions. Companies might take some foolish decisions or get caught up in a crossfire. They might fire great employees or hire a bunch of people who could lower their track record. Things can happen, and I want you to stand firm and make the right choice. Do not panic in the chaos. Know that your decision will be fruitful and wait for it. Conversely, if things seem falling too out of order, and there is a big chance that the company might hit rock bottom for a long period of time, sell stocks ASAP. Benjamin Graham said, "Successful investing is about managing risk, not avoiding it. Benjamin Graham. Things couldn't be any better for you. As a value investor, you aren't going to face this dilemma often. You have been in this game for a long time, and there is no way you should sell your stocks prematurely. After a decade or two, you will gain returns and dividends so high that selling a legitimate stock will make you look foolish. Pick the stocks only if you believe in the company and your research backs up your beliefs. When done correctly, as I taught you earlier, there is no way you will look out for selling stocks unless there is an emergency. All you will long for is buying more. The big money is not in the buying and selling, but in the waiting. Charlie Munger. Find great ETFs as a safety net and invest the remaining money into value stocks. A robo-advisor will help you to diversify your money across multiple ETFs, which could give you a great start. But also be aware that diversifying too much is not the best policy, as it might stretch thin your returns. Once you have the best index to invest in, you should open an account in a brokerage software, as listed in the previous chapters, and begin individual investing as well. Don't forget, your aim is not only to earn money, but to gain extensive knowledge as well in the real world through the trial and error method. In the beginning, you might feel intimidated by the overall investing concepts, but trust me, it only gets better with time. The magic formula. You may be wondering what magical formula I will be giving you in this section, correct? Any shortcut to becoming rich quicker or any formula that helps you to be more successful. You decide. The magic formula is the systematic disciplinary strategy that enhances your ability to learn more about value investing. It is an easy-to-understand method that many people use in today's world to win big. It leans towards a company's overall stock performance, providing annual returns that are sometimes higher than what the market or any other index funds like S&P 500 offers. What it simply does is that it runs a calculation with respect to the price and future returns of the stock and ranks them from best to worst order. Wishing to involve yourself in value investing? You need to implicate the magic formula. This formula was initially developed by Joel Greenblatt, who is an investor, hedge fund manager, and business professor. You can read more about his philosophy in his book, The Little Book That Still Beats the Market. It is cautious that this formula only applies to companies that have large market capital value, 100 million or more. Small and medium capital companies aren't included in the ranks. It is a proven formula that helps you outgrow your expectations. This formula considers two major values of the stock to rank them: the stock price and the cost of capital and returns. With this formula, investors were blessed with a quicker way to find and qualify their stocks based on the algorithm. Select the top 20 to 30 stocks and include them in their portfolio. They did it very efficiently using the stock screener tool. The unqualified stocks are sold within the first 12 months, while the winning stocks are kept in the portfolio for over a year. This helps in tax provisions and capital gains. It is a form of value investing because the stocks are purchased for a lesser price than the actual worth, and they are either held onto or sold for a higher return. This is how the formula actually looks like: EBIT divided by net fixed assets plus working capital. EBIT of a company is the earnings before interest or taxes. You can learn about these values from the 10K report or quarterly reports. Let me show you how you should use this formula to gain a solid list of potential stock picks. Using the screening tools, you can set a minimum capital for the stocks you wish to pick. Ensure that they are above the 100 million mark. Exclude every financial, utility, or foreign stocks. Gain the company's earnings yield from the annual reports or calculate them by dividing the EBIT with the firm's value. Next, you need to calculate the returns on capital, which could be gained through the main formula. The received stocks will be ranked from the highest to the lowest earning and returns. It is then recommended to buy stocks that rank in the top positions in the coming 12 months. You can definitely shake off the stocks that don't perform well and replace them with new winning stocks every year. If you repeat this process over a decade or two, the returns will be exponential. Greenblatt also mentioned that this formula has provided returns of almost 30%, which is astounding. Even if you didn't receive the marvelous 30%, you will still find some great bang for your bucks using this magic formula. Not everything is perfect, and this formula comes with its fair share of flaws and absolutes as well. The simplistic way to pick a great stock is definitely a nifty advantage. You can start right away without prior experience in the research field or being a trained financial professional. The only negative to this is that due to the latest market dynamics and additional changes, the returns you get aren't always rainbows and sunshine. Some investors and professionals also believe that the formula is incomplete and added new variables to gain better results. The magic formula is surely a great starting point for all those who aren't well rehearsed in research. However, should it always be relied on? That is a matter of discussion, and I leave it up to you. There are no second thoughts about investing, though. It is still one of the best ways to become rich over time. All you need is diligence and patience. Bill Ackman says, "I'm not emotional about investments. Investing is something where you have to be purely rational and not let emotion affect your decision-making. Just the facts." Bill Ackman. That was all the knowledge you needed to begin. There are a ton of valuable formulas for investing in value stocks that are coming up in the next chapter. See you there. The formulas. Definite formulas of successful investing. If stock market experts were so expert, they would be buying stock, not selling advice. Norman Ralph Augustine. Fairly speaking, the proficiency of valuing stocks is single-handedly the most crucial skill of all. No investor should expect to become rich through only gambling their way or following the herd. If you cannot value the stock's current price and its future worth, there could be cash fatalities. This chapter is dedicated entirely to help you gain insight on how to deduce the value of a stock and its performance, along with strategies to enhance your returns and reduce risks. Speaking of which, there are a few risks involved in value investing as well, like there are in other modes. It is necessary to know about the risks that you might be taking during value investing. Losses may occur in the short term, but there are some absolute returns in the near future. And that's what we are working towards through this strategy. However, everything depends on the stocks you pick. Here are a few risks that must be dealt with to gaze your eyes upon success. Investing risks need to be avoided. Number 1, not understanding figures. It is a great risk, as I mentioned earlier. No person is fully capable of making wise decisions without reading the financial reports first and understanding the company's selling point, demand, cutting edge, and vision. I've seen most people making decisions based on the financial statements, and that's the true way of value investing. But ensure that you have with you the most recent and comprehensive information about the company. Learn to see the figures, and you will be reducing a major risk of loss. Learn the skill of reading financial reports first, and then begin investing. You will find every detail you are looking for in the 10K report or 10Q report in the footnote section. Look closely. In the short run, the market is a voting machine, but in the long run, It is a weighing machine. Ben Graham. Number 2, tremendous gains and losses. It is well known that the stock market world is unpredictable, even to the most experienced eyes. Therefore, there may occur multiple incidents that could give a company a power boost revenue or strip them away from their profits. Incidents like lawsuits, research and development, restructuring due to natural disasters, and more. Companies do not have complete control over such circumstances, but it could mean a sudden rise or a terrible loss for you as an investor. Do not think about these during the analysis and decision-making phase, as it isn't consistent. The company's performance is to be measured by excluding such incidents. It is okay to make a judgment and be ready for rainy days, but do not expect them, though. Number 3, owning overvalued stocks. The whole point of value investing is to buy cheap and sell high, or hold when it receives its worth back. Making a mistake in calculations and buying the stocks that are already overvalued is not a great strategy because it defies the crucial purpose. Never pay more or the right amount for the stocks because that isn't how profits are gained. You want profits, pay less. Value investing isn't fully realized when you invest in the safety zone as mentioned in the earlier chapters. One of the funny things about the stock market is that every time one person buys, another sells, and both think they are astute. William Feather. Number 4, inability to diversify. Everybody knows that putting all eggs in one basket is a risky strategy. It applies to value investing as well. If you want to minimize the risk of losing money, diversify it across various industries and companies. Doing so, even if a particular company or industry receives a critical hit, you can lean back to your other investments. You don't always need 100 stocks to call it a diversified portfolio. You can simply invest in 10 stocks in various industries, and that is also a form of diversification. It is also wise to pick a few great stocks and invest heavily in them over a period to gain the maximum returns. Number 5, flowing in emotions. It is often witnessed that the temptation overshadows weak minds and pushes them to do things they shouldn't do. For instance, if you buy a stock and you suddenly notice that the price is falling down, you might be fearful and sell them off to reduce loss. However, you should stay calm and think rationally with a long-term vision. Is it a temporary or permanent situation? Can the company or industry cope up with this problem within 12 months? What does the hereafter look like for this company? Is there any chance that the loss can never be recovered? Answer these questions before making a move. The cornerstone metric. If I could give you one key metric to analyze and figure out whether you should buy that stock or not, then it will definitely be the P/E ratio. It means the price-to-earnings percentage of the company. To obtain this number, simply divide the share price of the stock by its earnings per share. To receive an astounding return, you need to get a lower P/E ratio. Because a lower ratio means you are also paying less money to buy that stock, hence value investing. However, beware of this because the ratio might be less because of a decline in the company's performance or a loss. Knowing the right balance is crucial. There are multiple methods to determine the actual P/E ratio of the company, like GAAP, GAAP, generally accepted accounting principles, earnings, adjusted earnings, etc. GAAP is the profit that the company obtains regardless of any unusual events, such as received tax incentives or business unit purchases. These unexpected, non-repeating events could cause the earnings to suddenly rise or fall significantly. Therefore, the adjusted formula provides an accurate P/E ratio for investors to scrutinize. There is a difference of perspectives regarding the P/E ratio by each investor. One may find a certain ratio promising, while Another could find the same ratio as average or unappealing because each one has a different goal in relation to their investments. Investors indulging in value stocks always prefer a lower P/E ratio. You can also deduce other ratios as well, similar to P/E metrics, such as price-to-sales ratio, price-to-book ratio, etc. The key to making money in stocks is not to get scared out of them. Peter Lynch. Valuation techniques. Buying and selling decisions are incurred after knowing the true intrinsic value of the stock. Going through the reports and juggling between media and news could be overwhelming, and there should be an easy way out. There is. I will demonstrate 7 proven techniques to help you discern the intrinsic value of the stock to enforce and elevate your investing acumen. Even the best stock in the world isn't good enough if purchased at an absolute premium price. It will only take longer to gain promising returns. Warren Buffett once said, "Price is what you pay, value is what you get." Warren Buffett. Look for the best value, but how could you determine whether the value is cheap or premium? It's by knowing the intrinsic value first. You can use multiple for confirmation or just choose one and stick with it. That's your choice, so let's begin. 7 proven techniques discerning the stock's intrinsic value. Number 1. Multiples of earnings. It is one of the most used methods of discerning stock valuation. However, it isn't absolutely accurate, though. In this method, you can take any valuation number of the company from the most recent report and compare it with the value of the company. Investors often rely on the net income, EBIT, earnings before interest and taxes, EBITDA, earnings before interest, taxes, depreciation, and amortization, etc. Remember, we discussed the P/E ratio? It's the same as valuing the company's worth with its net income. It is often recommended to use enterprise value to EBITDA or EBIT instead of just the P/E ratio. Enterprise value equals market cap plus market debt minus cash and equivalents. Number 2, discounted cash flow. When you're looking to invest in companies that hold a large sum of cash reserve, you need to use this method. These are mostly the blue-chip companies. It is a crucial method to know because you can estimate the cash flow of the company and yourself if you can be a majority or full owner someday. It is a simple formula to understand the current value of the stock is. Basically, if you are to own $100 per year for the next 10 years in cash flow, then is it wise to pay $1,000 for that many shares? Of course, no. There are some other factors like inflation that will reduce the amount of money over time, and your $1,000 will be worth far less in a decade. With this, you can even find out a company's future cash flow and bid accordingly. After knowing that value, simply compare it with the current value of the share, and you will have your intrinsic value. Decide if the stock is overvalued or undervalued. The only negative to this method is that you will be working with assumptions and projections of the data. Therefore, there is room for error. It may work fantastically for you, or it cannot for you at all. Either way, it's a vital tool to have in your arsenal. Number 3, Benjamin Graham's formula. We may have scratched the surface with this one in the previous chapters, but now we will have a deeper dive. This formula is helpful for cyclical companies that sell trending items during a great economy. It includes hotel chains, flights, etc. However, it can also be used for companies that have a volatile cash flow or a fairly new one without much background. We all know that Benjamin was a value investor who was always on a hunt to buy a basket of powerful stocks at a reasonably cheaper price. In his great book, The Intelligent Investor, He introduced a formula to discern the intrinsic value of a stock, which was later revised. V is the intrinsic value. EPS is the earning per share. G is the rate of growth over a decade or two. And Y is the current rate of returns. This is how it goes. V equals EPS 8.5 times 2G times 4.4/Y. This formula was introduced in 1962. It may not be 100% accurate in today's world. There are many who made certain revisions to this formula to make it more accurate. In any case, the quintessence remains the same. Number 4, ultimate PE formula. I recommend you to use this robust method of stock valuation for any sort of company. This formula enhances the PE value of the company in corresponding to its fundamental values that are earning the growth rate, dividend yield, business risk, financial risk, and earning visibility. Overall, if the fundamentals of a company are strong, the PE increases and the value. However, if the fundamentals of a company are shaky, the value diminishes. Basically, you will assign a value to each of the above mentioned and then discern the PE using the following formula. Fair value PE equals basic PE x 1 plus 1 minus business risk times 1 plus 1 minus financial risk x 1 plus 1 minus earnings visibility. Number 5, net current asset value. You must use this formula if you wish to find out if the company's stock price is relative to its net assets or not. It won't work for low-asset company. In this, you will fully analyze the balance sheet and get the valuation for tangible assets. This model doesn't actually apply to software-based companies. It is crucial to learn the liquidation value of the company because it gives you a reference to the base value of a stock. The companies are entitled as nets when their stock price is below the base or floor value. Calculating a net current asset value is simple. All you have to do is subtract all liabilities from the current asset. People are crazy to purchase a net stock unless the company does not have a decent business model or if they are blowing up money like crazy. Number 6, asset reproductive value. This model is vital if you want to know what it would take for a rival to duplicate the original business. This is where you will learn the true expense of building a replica of an existing company. It is a lengthy model with multiple inputs from your end. It requires you to analyze each line in the balance sheet and determine the change if needed. In the end, the value you estimate is the intrinsic value of the current business you are wishing to invest in. Number 7, earnings power value, EPV. This method will enable you to find some good potential companies. You can use this method as an extension to the asset reproductive value I mentioned above. The formula itself is really simple. However, discerning the earnings number is a bit over the top. For this, you need to analyze the income statement of the company and find the required adjustments. EPV is supposed to increase dramatically with the enhanced competitive advantage. Estimating the actual growth of a company is very difficult because there are various unprecedented factors affecting it. Therefore, you are most likely fine by sticking with the EPV for now. Undervalued stocks indicator. Based on your risk tolerance, available time, and the personalized goals, there are various investment models to help you find the best stocks to buy. Today, you have thousands of free tools at your disposal to choose and identify investment ideas. These tools are called stock screeners. Your broker's software might have one. Google Stock Screener and Yahoo Stock Screener are among them. There are also premium or subscription-based software that provide a deeper level of information than the free ones. Log on to your brokerage application and try to use the available screener. You can even add filters to gain accurate and personalized data. Filters like a range of PE, revenue, growth, income, dividends, etc. The screener will run its algorithm and, among all the listed companies, proffer you with the best. Value stocks are about as exciting as watching grass grow. But have you ever noticed just how much your grass grows in a week? Christopher Brown. In most cases, people are really confused about identifying the undervalued stocks, and thus there are 6 indicators that can help you discern them. Here they are. Lower PE ratio. We discussed it earlier, the significance of the PE ratio, didn't we? It is the value that portrays the value of the stock. The higher the PE value, the higher its price will be, and vice versa. If you already own a big chunk of the company, you want to wish that the PE goes as high as possible. Conversely, if you haven't bought any yet, look out for the stocks with a lower PE ratio. Lower price performance. When glancing over the companies, if you come across a certain one that has a lower price compared to its competition, then that could be an undervalued stock. It could be both good and bad news. Conduct keen research before approaching the decision. Nevertheless, due to bad news or any uncertain hit, the investors might sell off the shares and, in the midst, drive the value of the stock so down that it becomes an undervalued entity. You can compare a stock's price with its history and also among its competition. A screener is a handy tool indeed. Low price-to-earnings growth ratio. Investors often consider the PEG, PEG, to be more accurate than a simple PE of a company. To gain the PEG value, divide the price by earning value with the growth rate. If the resultant ratio is less than 1, that means that the stock is undervalued. If it is more than 1, then the value is exponential. A pro tip is to never rely solely on the growth projections because they aren't concrete, and only time could reveal the truth. High dividend yield. If a company is paying a higher dividend yield, it means that the stock price is fairly lower. Most people don't measure this metric and hence remain unaware of the impact. More dividends, meaning that the company is doing great and in the future looks secure as the dividend opportunity may increase, and thus the stock price as well. You are indirectly building a solid source of income for yourself. The dividend percentage in your respective screener tool can give you this data. Low market-to-book ratio. When the market value of the company reduces in relation to its book value ratio, shareholder equity, this phenomenon is referred to as an undervaluation. To understand this indicator, you need to know the true value of all the assets a company owns. Tangible, like real estate, cash, etc., and intangible, like trademarks, patents, and other forms of intellectual properties. You may all think that McDonald's sells burgers and French fries, and that's the fast food business they are in. However, they are really in the real estate business. Their franchise over the world is making them more money than their fast food chain. Sometimes when the stock prices decrease, investors forget about this area and thus reduce the price of the stock for you to buy as a value investor. Ample cash flow. Nobody talks about the gained profits, and everybody emphasizes the free cash flow. It is noteworthy to know the amount of cash generated by any company post-paying expenses. It may happen that the stock price might get lower due to lower reported earnings, but could still own a huge reserve of cash flow. The cash share ratio in your screener tool will give you this value. It isn't wise to just pick one of the above metrics and try to estimate the value of the stock. You need real reasons, and thus you need thorough knowledge and data. If multiples of the indicators point at a particular stock, then there is an opportunity waiting for you. When purchasing depressed stock in troubled companies, seek out the ones with the superior financial positions and avoid the ones with loads of bank debt. Peter Lynch. Just as you are striving to learn whether the stock is undervalued, you must also know to determine if the stock is overvalued so that you can skip them and move ahead. The same indicators mentioned above could help you in this matter when you glance in reverse order. If the current value of the stock is leaps and bounds away from the P/E ratio and the earnings forecast, then such stocks are referred to as overvalued. In the upcoming chapter, we will dive deep into the metrics of the stock valuation. You will learn its definition, pros and cons, and all the different types available. Let's close the gap and meet at the initial point of Chapter 5. The metrics. Achieving success with must-have metrics. The way to make money in the stock market is to buy a stock. Then when it goes up, sell it. If it's not going to go up, don't buy it. Will Rogers. Metrics define a massive role in the stock market world. But what does it mean? To understand it, you need to know that it is a collective assessment of a group of stocks to generally verify the quality and compare it with others, to discern and invest in the best. Traders and investors arrange it in the form of a dashboard to keep an eye on the performance so that they can scrutinize their current strategy or build a new one if needed. It is also noteworthy that metrics aren't just recently discovered. It has been around for ages, and throughout the history, people from all walks of life have used it to gain an upper hand and build wealth. What can a person do to collectively analyze the operation, performance, or accounting? He or she will use a certain type of metric for the evaluation. It is a general phenomenon in the world of finance where strategies are prerequisites. Stock analysts use metrics to form their own hypothesis, and they also recommend others about it. This is why we have thousands of strategies available to use by different people. Some work and some don't. It is an observation that people noted and shared with the world. Managers use many kinds of metrics to formulate an ETF, or mutual fund, to help people create strong portfolios. In organizations, people use metrics to determine their project performance. KPIs, goal achievements, marketing, etc. It has become an essential existence in every field, especially in the modern world of technology. When you look closely, metrics are nothing but a group of data that are assembled to create a definite result or conclusion. What do you think building a successful business is? Where do you gain knowledge of the value stocks? Why do analysts have a quicker grasp of scenarios than the others? It is all because of the metrics. Your exercise is a set of metrics that help you lose weight and grow muscles. You are totally surrounded by it, whether you like it or not. Might as well understand the concept and use it to your advantage. If you don't collect any metrics, you're flying blind. If you collect and focus on too many, they may be obstructing your field of view. Scott M. Graffius. Most people build their own metrics using the data source they have at their disposal. You can build your own metrics to determine your personal stock portfolio. A simple and extensive example of a metric is KPI, aka Key Performance Indicator. In an organization, managers and CEOs build a metric called KPI to define the role of every individual, track their performance, their goal orientation abilities, make informed decisions, and track their vision. A metric cannot be sustainable without a definite goal. Without it, what will the metric portray, and what is the meaning of that data anyways? It's never a metric, it's where the person is going or not. Metrics are used to make things work better, but don't necessarily make a business better. Keith Rabois. Metrics are not only used in business and the stock world, but it is also used for bigger things like evaluating the rate of unemployment in the country, the population, GDP, and also inflation. The list is endless. Today, everyone relies on a metric rather than a person because it always shows the truth. It is, as the old saying goes, numbers don't lie. When I moved into management, it was all about managing people and keeping them motivated. I didn't use sales metrics to drive my business. Now everything comes from the numbers. Jim McDonough. Vital stock metrics. Is your decision to buy or sell a stock purely data-driven, or is it because of the herd mentality? Making decisions based on a metric is absolutely crucial. Your emotions have nothing to do with it. The fundamental analysis section of stock may seem overwhelming, but getting the hang of it could be the difference between success and failure. To lend you a hand, I've arranged a few metrics for you so that you can understand how to use them while making a decision. For the sake of avoiding redundancy, I will skip the P/E ratio metric, as I've already told you about it in the previous chapters. It is one of the important ones, so make note of that. Let's begin the list of metrics now. Important list of metrics. Number 1, return on investment. Most people casually throw out this phrase a bunch of times, and I'm sure you must have heard about it as well. Return on investment, or ROI, as the name suggests, is a metric that defines your cash back on an investment. For instance, when you buy a Tesla stock for $200 and after a few years sell it for $500, that's an ROI of 150%. It is a simple metric formula that is gained by dividing the achieved returns by the initial cost or investment. You may be thinking that it is a very simple division, correct? Yes, it is. However, the cost of an investment may vary depending on the inclusion. The company may choose to include only a part cost rather than the overall cost. Number 2, compound annual growth rate, CAGR. It simply measures the annual growth rate of your investment over the span of 12 months. You know that the growth of a company isn't always constant. You might see a giant leap in some years, while some years may be dreadful. Therefore, most investors use this metric to evaluate their gains over a long period, like 5 years or a decade, rather than individual years. How is it helpful? You not only learn your returns on the current investment, but you can also figure out the returns on your entire investment portfolio. If you have invested in diverse stocks, mutual funds, ETFs, rental properties, etc., CAGR of it as well. By doing so, you will have an absolute idea of which investment is doing great and which isn't. You can add or discard accordingly. You can get the CAGR using the following formula. CAGR equals EV/BV 1/T minus 1. EV is the final investment value, BV is the beginning investment, T is the amount of time or number of years. As you can see, the calculation is a little difficult. Therefore, I suggest you use any online calculator to get accurate results. Number 3, return on equity. This metric helps you to decipher the profitability of a company. Basically, the company that can generate more money with the least amount of investment is considered better than others. For instance, if Company A invests $5 million in equity and manages to generate $10 million in profits, it is more efficient than Company B that invested $7 million to generate the same amount of profit, $10 million. The return on equity is higher in Company A. This metric is not always a standalone integral, People use it with other metrics explained in this section to gain a piece of insightful knowledge about the company. The formula is fairly simple. All you have to do is divide the net income by the shareholders' equity. Number 4. Debt to equity. Companies sometimes have debt, but carrying too much of it could be catastrophic. It is especially dangerous in an economic downturn like the pandemic. Therefore, you need to know the debt a company owns to make a just decision, because chances are the company might go bankrupt if the debt isn't paid soon. History is proof that most of the companies that have gone bankrupt had enormous amounts of debts on them. You can get this ratio by dividing all the liabilities a company owns by the shareholders' equity. Both of these data are available on the balance sheet of a company or on the reports. The ratio differs vastly depending on the industry. However, it is said that the debt ratio shouldn't be more than 2. If yes, then it could be a little problematic. Number 5, payout ratio. Dividend stocks are evaluated based on the payout ratio. Do not listen to social media or the news. Calculate for yourself, in case you're wondering that it's too good to be true. To get the payout ratio value, you can simply divide the company's annual dividend rate by its earnings. For instance, a dividend of $2 with annual earnings of $8 means that the ratio is 25%. It is considered a good ratio when it's between 10 and 35%. That's the initial payouts. However, it may increase as the company matures. However, do not invest if you are getting a payout ratio of closer to 100% or more. It could be a sign of unstable growth. Less than 60% is what you should be aiming for in the long run. Number 6, beta. Most people aren't aware of this metric. It indicates the movement of a stock or its reactivity when compared to the overall market. The market means the S&P 500 index. If you gain a beta of 1, it means that the stock aligns with the S&P 500, which means that it holds an upward movement of 5%. It is a reactive stock. On the contrary, if the stock beta measure is less than 1, it's less reactive. The bigger the number, the higher the volatility of a stock. For instance, with a beta of 0.2%, there is a 5% move in the S&P 500 index, and it should generate a market swing of approximately 2%. An opposite direction or downward movement means a negative beta. It is a metric of volatility. Number 7, free cash flow. This is the metric where even the most experienced investors remain stalemate. They don't quickly realize that a company's earnings have nothing to do with the amount of money coming in. External factors like depreciation or inflation could change the face of the earnings. The free cash flow is the amount of money generated by the company at any given time. You can gain this data from the cash flow statement. Simply subtract the company's capital expenditure by the cash flow. It is important to know because when you are looking at the P/E ratio and couldn't make the ends meet, this metric will work as the missing piece in the equation. Number 8, price-to-book ratio. This is the straightforward metric helping you learn whether a given stock is undervalued or overvalued. A company's net value when compared with its market capitalization results in this ratio. It indicates the amount you'll be paying for every dollar that a company generates in its net value. The primary difference between a stock's market value and book value is why most investors use this metric. The P/B ratio of 1 or anywhere closer to it means that the stock price is closer to its book value. What you are looking for is, as a value investor, is for this number to differ from 1. Too high means more overvalued and too low means undervalue. Investors will gladly pick a stock with a P/B ratio of 0.5 rather than 0.9 because it dictates that the market is undervalued and the chances of exponential growth skyrockets. This is an opportunity we are all waiting for, to get our hands on a stock that has its market value less than its book value. Number 9, PEG ratio. Price to earnings growth is an advanced metric over the standard P/E ratio that includes the earnings growth as well into the equation. We've seen that the P/E ratio isn't an accurate growth forecaster. PEG helps you to determine the value P/E ratio and its earnings growth. This is a more accurate version that defines the value of a stock in the marketplace. The formula suggests that you divide the P/E by the annual earnings per share growth. If the answer is less than 1, it's undervalued. And if the ratio is higher than 1, the stock price is overvalued. All the metrics listed above are used by value investors to dignify their decision. However, there are more specific metrics that I'm going to share with you in this section. Not every stock is 100% safe to pick. Therefore, you need to seek refuge in the arms of a metric that will advise you whether to go for it or run away from it. It is assumed based on the profitability growth and balance sheet. Metrics are very high in supply chain executives and users. It's rare to see a supply chain vendor that doesn't have some performance management capability built into its system. Adrian Gonzalez. To be doubly sure, use multiple metrics to retrieve decisions. Some of the outstanding opportunities await on the other side of using these below listed metrics. Specific metrics. Number 1, price to sales. When the market capitalization rate of a company is divided by the annual gained revenue, you get the price to sales ratio. Earlier, I disclosed that companies cannot be only judged based on their earnings. That's why this metric helps you to easily compare the competitors and reach a worthy conclusion. Market capitalization is the current market value of a company, and it's a product of overall outstanding shares and current share price. For instance, if a company's share price is $5 and its outstanding shares are 1.5 million, then the market capitalization of that company is 7.5 million. If you need a more accurate value, use debt in the equation as well. Fewer sales and a debt-free company are better than more sales and great debt. Number 2, profit margin ratio. It is the ratio that signifies a company's profits. Simply divide the profits by the revenue generated. If a company is well efficient in handling its finances, this ratio will be positive, and it's a good sign. It is compared to the sales and the profits gained from it. It is always appreciated if the sales are good enough to earn more profits so that there are often more dividends paid out to the shareholders. It's a sign of great investment. I believe that metrics pave you a definite path. Without it, most of us will be lost and on the verge of losing a lot of money. That's why this chapter was necessary for you to understand the various metrics available at your disposal to use as fit during the stock valuation. In the next chapter, I will decipher some of the important screening guides and investment strategies that will help you gain more profits and make a better judgment. All that is waiting for you in the next chapter. Let's go. Techniques 101. Strategies and Guide in Building Wealth. The goal of a successful trader is to make the best trades. Money is secondary. Alexander Elder. Strategies play a crucial role in stock investing. There are numerous of those out there for you to choose from. Pick the one you've tested the most or the one that projects definite results and stick with it. This chapter is included to help you find the strategy that will build your wealth. It is, as Steve Clark said, do more of what works and less of what doesn't. Steve Clark. Today, most people take the index fund approach for security reasons. They know that their money is safer in an index fund rather than investing in any individual company. Index or mutual funds are diversified and managed to proffer returns over the long term. However, experienced investors or professionals often try to select individual stocks because they know that there is another side to this equation. Investing in one company that takes off big time could give you way more return than any index fund ever could. You already know what happened with Tesla, don't you? It is easy to pick an ETF or any other index fund. Simply find the best collection of top blue-chip companies and other stocks. Invest and now wait for it. This chapter will teach you how to pick common stocks and commit to value investing. The returns will be higher than what average investors get if you do it right. So, let's get to it. Benjamin Graham's strategies. Benjamin Graham, titled the father of value investing, was the first man to invest in stocks using financial analysis. He obviously became successful, and thus he mentored one of the brilliant minds of our time, Warren Buffett. The strategies and skills he developed in his time are still polished and used by professionals from all walks of life. He is also the man to argue against the philosophy of holding money in index funds just for the sake of slow security. He believed in facts and figures and spent his life using them to fuel his portfolio with stocks that helped him build his fortune. In his book, The Intelligent Investor, he speaks about 5 different stock market strategies, or categories is what he called it. I am going to share them with you now. Stock market strategies. Number 1. General trading. This category of investors tries to anticipate the market movement and compare it with the data they already have. It simply means distributing your investments in a wider space to reduce the heavy impact of losing cash. It also inhibits buying stocks when they are at the peak or overvalued. Novice traders trade 5 to 10 times too big. They are taking 5 to 10% risk on a trade they should be taking 1 to 2% risk on. Bruce Kovner. Number 2. Selective trading. Based on the research, some investors only pick stocks that will do better than others in a short period of 12 months or less. It may sound enticing to you now, but trust me, it is easier said than done. Nevertheless, you can always keep into consideration some of the factors like market change, competitive advantage, or government rule changes while making a solid decision. In this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. Peter Lynch. Number 3. Flipping stocks. It is the good old buying cheap, selling premium strategy. In the stock market world, most people follow the path of buying shares while they are still rising, and they sell them as soon as they start to drop. That's not how you make a profit. Value investors like you and me are different. You must always, and I repeat, always buy when the stock prices are the lowest, and sell them when they are at an all-time high. In investing, what is comfortable is rarely profitable. Robert Arnott. Number 4. Long pull selection. This is the method where you will only pick companies that showcase the huge promise of growth in the long run over other companies. You may have heard about the growth stocks. That's what they are called. These are the new startups or enterprises that solve problems and have more room for growth. There is no single market secret to discover, no single correct way to trade the markets. Those seeking the one true answer to the markets haven't even gone as far as asking the right question, let alone getting the right answer. Jack Schwager. Number 5. Bargain purchases. When you follow a certain technique to evaluate the stocks, you only choose the ones that are being sold for a lesser price than their true value. P/E ratio is one of the techniques used to measure this phenomenon. In investing, it's not about how much you make, but rather how much you don't lose. Bernard Baruch. There were a few of the categories from Graham's book. There are various other tips he has to offer that will help you along the way. You seriously didn't expect it to be that simple, did you? He did try to keep things simple, but the criteria for evaluation aren't complete. Here are the tips you asked for. Ben Graham's simple but powerful tips. The price-to-book ratio is very important before you pick up any stock. See if it is below 1.0 and only then buy it. The P/B ratio is the comparison of the stock price with its assets. However, there is a drawback in this method. It doesn't work on companies that are incapable of producing huge capital. If you are still not sure about it, then choose the company whose P/B ratio is lower than any of its rivals. The P/E ratio of the stock you are picking must be lower than 40%. The share price should be lower than 67%, less than the company's net current asset value, NCAV. The total debt of the company should always be less than its total book value. Fundamental analysis. No matter what strategy you use, everything boils down to this one final element, the fundamental analysis. Every value investing is incomplete without it. Scrutinizing the qualitative and quantitative factors of a company to gain more information about its intentions and vision is an essential component of value investing. If you're thinking about what type of conditions I'm talking about, it includes the economic, market, and financial conditions. Furthermore, the technological and industrial conditions also apply to this metric. When examining the fundamentals, you also discover the risk tolerance of a company against the risk it's actually taking to make money. As a value investor, you need to ensure that a company's ability to generate profits aligns with the growth potential so that when you pick them over the long term, you can eliminate all regulations or risks to losing money yourself. The cash flow, sales revenue, research and development, its earnings per share, etc., are to be known. Many serious fundamental analysts study everything they can that holds the potential to impact their stock-picking decision. In the end, you will have the true value of a stock. You may be wondering that they have access to some special data that helps them, but that is not the case entirely. They mostly use publicly available data and keenly observe each component to decipher their conclusion. Everything they have access to, you have too. Basically, analysts estimate a stock price and what it is worth in comparison to the market. It's also known as intrinsic value. If their calculation describes that the intrinsic value of a stock is far higher than its current price, they label it as undervalue and initiate a buy action. On the contrary, if the intrinsic value of the company is lower than its current market price, then they label it as overvalued and initial sell action. The qualitative measure includes hardcore numbers that could be retrieved through financial statements. You will analyze the revenue, assets, profits, debt, dividends, etc., to gain a piece of precise information. The company's brand, all the intellectual properties like patents and trademarks, which it holds, are all included in it. Some of the qualitative fundamentals that you should consider as follows. Number 1, the business model. It means the whereabouts of the company. What does the company actually do? What are the products they are selling, the problems they're solving, their unique selling proposition, etc.? Also, look at McDonald's. Are they only making money through their burgers and fries? No, they also make a tremendous amount of money through their franchise model. That must be taken into account. Number 2, competitive advantage. A blue ocean strategy, in simple terms, means that you have something that nobody else has, an edge that sails you to the land of monopoly, or gives you an unfair advantage over your competitors. It is a long-term success that holds if the company can maintain its edge. Microsoft dominates the personal computers industry, albeit Apple is popular, but due to their expensive price, most computers run a Windows operating system. The licensing model, which Bill Gates introduced with its product, expands as more and more computers enter the market, and now averages to all laptops, tablets as well. Your job is to find companies that have an unfair advantage over others because they will take care of you as an investor for many decades. Number 3, the board or management. Most investors think that the management sitting at the top and making a decision is more crucial to decide whether it's worth investing or not. It makes total sense to me because if the management is lousy or without a vision, the company is doomed anyway. Why do you want to invest in a company that has no future? That's what it means. Enthusiastic management with a vision and definite plan is worth way more than even if they are just starting. All companies that have achieved legendary success have this one thing in common. They are driven by a passionate mind that wants to disrupt the industry and help people in the process. The billions are then just attracted to them. However, it is also true that having a goal and having the ability to execute it are two different skill sets. Those who lack the latter are surely failing. Even though fundamental analysis seems a great proven concept, it also holds some levels of criticism, mainly from the group of people who follow the typical technical analysis and those who believe in an efficient market hypothesis. Technical analysis in its base form is simply a method of analyzing a stock based on its price and volume. This ignores the fundamental component. They believe that the stock's price holds more information and insights than any of the business fundamentals. Conversely, the efficient market hypothesis means analyzing the asset prices. The people who follow this hypothesis believe that that's all they need to suffice their decision. They also discard both the technical analysis and the fundamental analysis. They agree that the market cannot be beaten through these methods. They also preach that since there are way many investors in the queue, it is basically impossible to outperform the market. Even though it is very difficult to beat the market, there are people who've accomplished it. I am not saying you or I could do it with a few years of experience, but do not confine yourself within it. The stock screener. What if I tell you that there is a way to build a portfolio just like Warren Buffett or Charlie Munger? Would you really be interested? I learned that there are a few things you can do starting now to have a screening process just like them. Stock screening simply means analyzing the stocks. These great minds are capable of building such tremendous wealth because they have a powerful screening system that allows them to find the best picks for their investments. For over half a century, these legends have shown that there is a way to build massive wealth if you choose right and delegate the rest. Time is your friend. Impulse is your enemy. John Bogle. It is no surprise that Buffett ranked his company, Berkshire Hathaway, to be one of the few companies in the world to cross the $500 billion mark. Compared to his 50 years of experience, his returns were magnificently over 23%, which is more than an index fund or mutual fund offers. A Buffett screener needs a few elements to filter out the best, and they include criteria such as growth on the earnings per share, gradual return on bought equity, a good return on the invested capital, aka ROIC, low debt in the company, etc. And finally, the screener takes into account the cash flow, DCF, to calculate the actual margin of safety. Overall, it begins from a single question that Buffett likes to ask. Is the company profitable? And is it generating regular cash flow? Once he gets the answer he seeks, he will then go on to estimate the returns or cash flow of the company over the upcoming years, a decade or so. After discounting, if he gets to the DCF to be higher than 30% than the company's market valuation, then he considers it to be a good margin of safety, thus proceeding with the purchase. Building a workable stock screener requires 4 crucial elements, and they are as follows. Stock screener's crucial elements. Model the Warren Buffett criteria. Execute those metrics into a unique screen. Learn the understanding of Buffett's mindset of how he actually evaluates the company, business, or the industry itself. The final step is to choose the options your screener throws at you and invest only in them. Let's dive deep into each section so that you can build a great stock screener for yourself. Screening is the filtering process, and you need to add factors against which the stocks could be scrutinized. You can begin with finding the intrinsic value of the stock and then calculating the margin of safety. Your aim is to find companies that have their intrinsic value higher than their current stock price. One of the things Buffett does is this. He calculates the cash flow of a company over a period and then discounts it against the inflation and other possible factors to get the actual future cash flow value. In this, you need a higher margin of safety. I always say that if you know what you are doing in the stock market world, it isn't gambling anymore. If you can learn to create a state of mind that is not affected by the market's behavior, the struggle will cease to exist. Mark Douglas. Next, find the earnings per share value of the stock. It is an essential component in creating a Buffett screener. He tries to look for companies that are consistently growing over 5 to 10 years. That's the secret. Later in the chapter, I will give the top list of screeners that will help you big time. It is time you understand how Buffett scrutinizes a business or an industry before investing. Some of the factors that Buffett exclusively considers are competitor-related. You won't find this information on the financial side. You need to conduct additional research to learn about it. Here's a few of them. Factors to consider before investing. The Buffett's way. Does the company have a USP, unique selling proposition, or at least a competitive advantage over others? This is related to a certain type of work, algorithm, technology, etc., that only they have and nobody else. And most importantly, is it good for a long-term basis? Do you, as an investor, understand what the product does and what it's capable of, or how it works? If not, then you shouldn't consider investing. It is said that if you don't understand something, do not invest in it. Most people are unaware of Bitcoin and how it actually works. Therefore, it is not for everyone to invest in. Is the company financially free to raise their prices when they see fit? Because when inflation hits, there will always be a need for that. Does the company only invest in what they know best? The same psychology is applied to them as it applies to you. If the company does not have the expertise in any area, and if they invest in it, there are chances that they might lose money. And hence, you as an investor could suffer the damage as well. What is the company's market condition? Is their price taking a hit? Are they going through some kind of recession? And finally, could this problem be easily solved? If the answer is yes, then Buffett loves to invest in these companies. That's where his famous quote comes into play. Be fearful when others are greedy, and be greedy when others are fearful. Warren Buffett. Is the company focusing on buying back their sold shares? It could be a clue that the management has a plan to gain tremendous profits, and the future looks brighter for them. Thus, invest heavily into it so that you can be part of it when it rains money. When you apply all these filters to your screener, you will get a list of companies that passed the test. Invest in them. Buy and hold the stocks. Never sell them for a few pennies. Hold on to them so that you can earn more in the long run. There is a time to go long, a time to go short, and a time to go fishing. Jesse Livermore. Best stock screeners. Using the right screener is as important as committing to research to pick stocks. If you have the right tool, the output will be profitable. There are many softwares that could help you build a solid screener, but let me share with you a few of them that I find interesting and that works well. Below are some of the top screeners out there. TC 2000. It is a great screener that helps you to create charting systems, and it works in both the USA and Canada. The price is amazing, and you get your hands on real-time data. U.S. and Canadian investors and traders can use it for a wonderful charting system that abides fundamental and technical analysis. It also proffers you an option to create your own filters and indicators. Stock Rover. While most value and growth investors believe it to be one of the best screening software available for individual stocks, ETFs, and mutual funds, you can get a detailed value for the margin of safety, intrinsic value, paid dividends, etc. It has a substantial rating system for stocks with a massive selection of criteria to use as a filter. You can get data for the past 10 years of any stock. It also includes the Buffett Screener and Graham Screener. The setup is easy to install and execute. TradingView. It is a great global screener to help you screen stocks from different countries. It displays a distinct view of the fundamental and technical analysis. You can add filters to get the stocks you want. Most day traders use it to gain the most value of their bucks. The criteria selection is good, and you have access to international markets along with cryptocurrency and commodities. It also features an easy setup process. However, it doesn't have a decade of historical data about a stock like the Stock Rover does. I'm curious which stock screener you liked the most out of the three. There are, of course, other tools as well, like these. Atom Finance, ZAC and NASDAQ Screener, TradingView, TD Ameritrade, FinViz, Market Gear. Since now you know how to screen stocks and pick the best one, it is time to teach you the buying and selling metrics of the stock market world. In the next chapter, we will dive deep into this segment. See you there.
The best part. Let's make a fortune. Buy things that are going up, sell things that are going down, and when they stop, get out. Rob Smith. Giving up on a stock is not what a value investor should often do. But there are times when you need to get out of a mess, and in those scenarios, you need to know what selling is all about. The same goes for buying. Buying and selling stocks at the right time is key to success. You cannot grow otherwise. What kind of return will you gain and how much loss to avoid? This data will be proffered to you when you commit to these two things appropriately. The amount of money you will make from stock is already decided in the moment you click on the buy button. Its actual revelation happens after it is sold. If the bid is higher, then congrats. You just made a profit. Or else you suffered a loss. Selling is when the true profit surfaces. Markets are constantly in a state of uncertainty and flux, and money is made by discounting the obvious and betting on the unexpected. George Soros. I've met and probably seen many investors who do not have any idea about selling a stock. They often make the mistake of committing to that decision because of their emotions. That's not how a value investor should function. Greed is the most noticed emotion, right along with the fear that empowers the selling conundrum. From this book till now, you must have learned many strategies to understand when to buy, haven't you? Those strategies were taught to you so that you can make the best decision without falling victim to your emotions. According to Investopedia.com, there are primarily three main reasons to sell a stock. First, buying the stock was a mistake in the first place. Second, the stock price has risen dramatically. Finally, the stock has reached a silly and unsustainable price. Perfect time selling your stock. Are you wondering how greed and fear could dangle your decision and consume you? Here is a perfect example. Suppose you bought a stock for $100 and you estimated to hold it for now and sell it when it reaches $140. After a few months, your estimation became true and the stock finally hit its all-time peak of $140 per share. Now you think for yourself that since the stock is currently rising, let's wait a little longer to see how much higher it goes. The stock hits $150 and now you are happy. You again wait to hope for the stock to break records, but unfortunately, the stock drops down to $130. You're sad, but you pat yourself on the back and whisper that you will just wait for it to return to $140 so you can sell it for your initial estimation. Things start to go south and the stock starts to lose its value further and drops to $90 per share. You are taken over by extreme frustration and you decide to sell it at a loss of $10 before it collapses even further. That's the power of fear I was talking about earlier. You could have made a profit of $40 to $50, but you let your emotions run wild and lost the opportunity to sell. You didn't read the market well, and thus it backfired. You instead suffered a heavy loss of $10 per share. If you had bought 10 shares, then, my friend, you just lost $100. That's catastrophic, right? A true value investor understands that emotions could become its enemy, and thus your best course of action is to discard yourself from this equation. Do not interfere with the system. There are options to set the order for purchase and also to set a limit to sell. Meaning, if you enter the limit order on the brokerage software, it will automatically buy the stock at the price you set and sell it when it reaches the price you assumed. Do not mingle with it in the meantime. Selling stock is hard. Most value investors avoid it. Even Warren Buffett advises not to sell stocks. Nevertheless, there are a few situations when you have no other choice but to sell them. Number 1, when you buy the wrong stocks. It is possible that the results you deduced from your research might not be accurate, and you took the action of buying the stocks only to realize that you have no chance of making a profit. When you understand it, you must sell the stock as soon as possible for the lowest loss. The error you made may cause you cash, but it is better than losing all the money. Your findings are everything to you. Always trust them, but make sure that the methods you adapt give you successful results. If a mistake is identified, or if the decision was merely based on impulse, sell the stock immediately. Now, at this point, the stock might either go up in value and make you feel bad, or it can fall further ahead and save you a lot of money. Don't be sad when it goes up because it was only a lucky guess, while in reality, your research proved it to be a failure. It's a smart move indeed. Conversely, if the profit you imagined couldn't be gained in the short term because of silly reasons that could be overcome, do not panic. Give it more time and then examine it again. If the loss incurred to the company or if a competitor takes over the market, then you must sell the owned stocks fast. Number 2, when you gain an exponential profit in the shortest time span. Everybody likes to see the stock go up, especially if they own them. But it is not a good sign to see a stock climb the ranks in the least time expected. As a value investor, it is your duty to analyze the phenomenon, and in most cases, the rise is only an initial sign of a giant drop. It will be in your best interest to sell the stocks as fast as you can to hog all the profits you have now and save cash in the long run. I would also like to point out that there are companies like Tesla that grow fast in a short time, and it's worth investing in because we all know that it will keep climbing higher. Definitely consider it while making a decision. I would like to give you a secret tip. When the stock reaches a maximum height in the shortest time, you can immediately sell them and sit back with the profits in hand. As estimated, when the stock hits rock bottom, you can buy them again for a cheaper price than before, assuming the core values and the foundation of the company is still intact. Pretty cool, isn't it? Number 3, imprecision valuation. The future is always unpredictable, and there are more fair chances of choosing the wrong stock or arriving at an improper valuation. A stock's current ability to create future cash flow is the key to making a buying decision. Now you know why investors lean towards the maximum margin of safety. Only invest in a company that outperforms its rivals in the long term. It is, as Peter Bernstein mentioned, the fundamental law of investing is the uncertainty of the future. Peter Bernstein. Number 4, if the P/E ratio increases significantly. When you notice this situation, sell the stocks quickly. In the coming decade or two, if the value of the P/E ratio increases dramatically, then it could be a sign that you need to sell your shares. Number 5, when companies let their employees go. A cost-cutting company is not a profitable company. If they fire people just so that they could survive a little longer, then it's a sign for you to sell the stock and look elsewhere. You can learn it from their revenue. If it is declining, means that customers aren't interested in their products, and thus they have no way left to support themselves. Most people think that when companies let their employees go, they are claiming back their shares. Thus, they buy more shares themselves, only to find out the inevitable. Take the clue and free yourself. Number 6, if you need money. It is not the best reason yet to sell the stocks you own, but it is definitely one. The future is unforeseen, and there you might get into a situation where you need money. It is not a great news, but what else can you do? Sell stocks and fulfill your emergency needs. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. Paul Samuelson. Number 7, when the stocks perform as expected or if it exceeds expectations. Only thing holding you back during these situations is greed. If you can overcome it, you will have a profit within your grasp and the confidence to invest more and earn more. It is also a smart choice to notice that the company is getting stronger financially and spreading its roots deeper into the market. At this time, you can choose to keep the stocks you have with you, or you can buy more and hold them. I know you may be thinking that it contradicts my greed thesis, but no. Emotional reason to hold the stock in the hope that it will rise is different than a rational decision of holding a stock knowing by the fact that it will increase in value. Learn to know the difference. Number 8, when you find another stock that has higher growth potential. Investors seek profits all day long. If they find a great deal, they will lean towards it without a second thought. Suppose you're investing in a company and start to notice that the competitor is growing rapidly while maintaining stability and showcasing a promising future both rationally and emotionally. Then you must sell the stocks you own and buy into another company. Or you can keep both in your portfolio, assuming both companies will grow. The same things happened with Yahoo and Google. People were using the Yahoo search engine until Google came along and grabbed the market. People who invested in Yahoo had a great opportunity in front of them. People who stayed with Yahoo may have repented it as Google takes over, and people who switched repent today that they should have bought more. Google is worth more than $1 trillion today. Imagine if someone would have bought 20% to 30% of the company back when it was first launched. The mere thought of it gives you freaking chills of excitement, right? I understand. Warren Buffett sold his entire 5% shares in Disney because he thought that he would find better returns in some other company. Number 9, if there are unwanted or disliked changes. It is a great strategy to invest in a company that has powerful management to the claim. Nevertheless, if the management changes completely or if they made some significant changes that you disliked, you have the right to no longer stay in the company as a shareholder and find another company. You're a partial owner of the company, and you have that power with you. If they deviate from their original values, if the CEO changes and it's not good enough than the previous one, or if they added some board members who are actually destroying the company, sell the stocks and leave immediately. Purchasing a stock means that your mindset shifts to being an owner of the company. You can decide what is good for the company and what is not. If the company changes things that you dislike, there is no reason for you to stick with you, unless the returns are outrageous. We want to perceive ourselves as winners, but most successful traders are always focusing on their losses. Peter Borish. Number 10, your buying reasons do not exist. There could be various reasons why you chose to buy that stock in the first place. It is time to examine where the reason is still valid today. If not, then what is that stock doing in your portfolio? It must be gone. Most investors have a reason to own a particular stock, and that is not always money. If that reason isn't justified presently, or if there is no room for it to avail itself in the future, then consider selling. Number 11. If the owned company is being acquired by others. When a company is acquired by another company, chances are that the prices will fluctuate depending on the mode of purchase. If you do not like the company it is acquired by, then you can think of cashing out. For example, when Facebook offered to buy Snapchat, they declined the offer. However, WhatsApp agreed to the deal. Therefore, if people who invested in WhatsApp because of its history and values do not like Facebook, they could have exited the market and gone looking for Signal, another social media communication company like WhatsApp. Number 12, an imbalanced portfolio. Often it may happen that you buy multiple companies in the same sector, which could be risky at some point. If you want to rebalance your portfolio, you need to sell a few stocks and diversify to avoid risk. That also brings balance and order to the portfolio. Number 13, when trading volume decreases. The volume at which a stock is bought or sold is important. If you suddenly notice that the volume is significantly less than what it used to be, then think about selling it or reevaluate the company to justify how they will cope up with the situation to grow profitable. Number 14, when stock becomes a media sensation. It is said that if you find a stock hyped in the news, it's too late to join the party. This is the time you should consider taking the profit and exiting because it's the peak of success. The profits may grow either very slowly from this point forward, or it will fall horribly. Either way, you gain the profit you were looking for and more, so sell it now. Number 15. When stocks stop growing. Companies have a particular share in the marketplace. Once a growth company acquires the market, the usual growth rate decreases, and there are no sudden massive returns to be expected from them. You should sell the stocks and materialize the profits you gained. Selling a stock is always supposed to be a happy moment, as it declares the fruit of your diligence and patience. There could be endless reasons for selling a stock, but the above mentioned some of the common ones. Selling stock will help you realize your win or loss. Either way, you will learn something new that will stay with you for the rest of your life. Frankly, I don't see markets. I see risks, rewards, and money. Larry Height. Worst reasons to sell a stock. Stock price decreasing for a short time isn't a valid reason. The market fluctuates. Sit aside and don't touch them until it's absolutely necessary. Just because stock prices increased a little bit is not a valid reason to sell either. Give it time to grow. Don't be greedy or too conservative. The growth could be just beginning. Just because other people are selling doesn't mean you should too. Discard the herd mentality. Their perspectives regarding the stock are different than yours. Stick with your philosophy and research. Your conclusion matters the most, not what other people are doing. Perfect time to buy stocks for a maximum profit. Your ultimate reason for buying a stock shouldn't only be because you had money. There are many other factors that energize this decision. This could really be a fun activity. Here are some of the factors portraying why you should be buying stocks. When they are on sale. Like any other product, stocks also come out at a pretty low price during the sale season. It could be a Black Friday, Christmas, or a Cyber Monday, doesn't matter. You must be ready with the money to buy some of the stocks you've already researched on. You may find that other investors simply avoid this time of the year to buy stocks, but it's a good chance for you to get the stock at a reasonably cheaper price. If you follow the market crashes and tragedies, mostly it's the best time to buy stocks after the crash because everything is available at a cheaper price until the market stabilizes again. When stocks are undervalued. Well, this is the whole point of value investing, isn't it? If a stock is trading for a lesser price than its true value, grab your hands around it and don't let go. Using the methods taught in the previous chapters, you can easily identify the undervalued stocks and buy them. Dividend, sales, revenue, profits, cash flow, etc. are some of the factors to consider. When your research is complete, value stocks are called so because they provide returns in the long term. Therefore, if you find these stocks, it doesn't matter much what price they're trading in. You can buy and hold them and let compounding cast the spell of growth and significance. Read the reports, scrape through the finances, and scrutinize the ones that make the most sense. Tony Robbins said, "It's not what we do once in a while that shapes our lives. It's what we do consistently." Tony Robbins. Your consistent buying and selling decisions will make you a better investor over time. These philosophies of buying and selling differ from one individual to another. Develop your own unique way and stick with it no matter what. That brings us to the final chapter of the book, which is dedicated to providing you with various tips and techniques. It includes how to beat the market and how to gain profits in the Buffett way. You will also learn a few new ways of determining an undervalued stock. Keep your cash ready, and let's get to the last chapter of the book. See you there in a huff. From the Elites of Investing, Elites Tips and Techniques. The core problem, however, is the need to fit markets into a style of trading rather than finding ways to trade that fit with market behavior. Brett Steenbarger. Since the beginning of the stock market world, there have been multiple methods introduced, applied, and passed down from one decade to another. In the midst, there were a million tips preached by thousands of experts who lived before us. Today, we have access to anyone worldwide through the internet, and thus we also have access to their life, teachings, and more. It is very easy to research someone, read their books, and learn about what they believed in, and model it in our own life. In this chapter, I will provide you with a few tips that I found to be useful in your investing journey. Here's one for you from Randy McKay. I'll keep reducing my trading size as long as I'm losing.
My money management techniques are extremely conservative. I never risk anything while approaching the total amount of money in my account, let alone my total funds. Randy McKay. We must now begin. The approach and success. The best approach for you is value investing. There is no definite way to succeed otherwise. There are many stocks that showcase greater growth over the long term. The only problem we have is to find them and invest. It is true that the growth stocks have the most chance of showcasing profits, but it isn't true always. The stock price comes in the way, and there are many factors that affect the future as well. You could even derive a wrong conclusion due to human error. It is seen that most investors only aim for a short term, and when things start to shake, they panic and make rash decisions. That shouldn't be you. Benjamin Graham witnessed a similar problem in his time, and he needed a way out. He wanted to discard the risk completely so that investors could trade appropriately and gain profits. That's when he developed a thesis about the intrinsic value. He believed that this paradigm could help investors to learn more about the stock's performance and thus make the right decision. The elements of good trading are 1. Cutting losses, 2. Cutting losses, and 3. Cutting losses. If you can follow these 3 rules, you may have a chance. Ed Sakota. We discussed Graham's approach in length in the previous chapters. You can refer to that again for a better understanding. According to Graham, there are 2 types of investors. First are the ones who excel in defense trading, and second are the ones who indulge in more aggressive trading. In the defensive group, there are people like professional doctors, lawyers, lecturers, or any sort of full-time job that do not leave them any time to concentrate on the stock market. This also includes sharp young boys and girls who haven't gained full control or experience in this field. They often trade defensively. To this group, Graham recommends that they should only invest in established companies that have a solid track record of growth, also called blue chip companies. In his book, The Intelligent Investor, Graham mentioned some specific rules for this group of people. They should find out the size of the company and invest in only those that have annual revenue of more than $100 million. Sure, these estimations were projected around a couple of decades ago, so there is a hike since then to these numbers. Companies should have a great financial condition like cash flow, inventory, and other forms of assets. On the other hand, Graham believed that the second group of people known as aggressive investors should diversify their horizons and invest in multiple companies while taking an active part in research and findings. They should also stay away from the news or any new issues because it could be a false alarm. Graham always picking stocks that meet all his criteria. Till now, we have already know a few of his filtering factors, like dividends, price to book value, earnings per share, and price to earnings per share, PE ratio. But did you know that there are 3 more factors that he used to consider so that his portfolio is filled with value stocks? Let me elaborate on this. Graham's additional stock picking criteria. Number 1, quality check and rating. Investors live in dogma that they must have the best companies of all time in their portfolios. However, that is not the case in every situation. Benjamin believed that the quality of a stock could be average or a little better, and it will still do fine. He had a standard rating system and officially recommended that companies with S&P earnings and dividend ratings of B are great to have in a bucket. Of course, the higher the rating, the better. The S&P rating system includes grades that range between D to A+. If you want to be on the safer side, choose companies with a rating of B+ or higher. Number 2, current ratio. Most of you may not have heard about it until now, but it is a factor to be considered. The current ratio is gained by dividing all current assets of the company by all its current liabilities. If the ratio is 1.5 or higher, pick it swiftly. Many investment companies and services prove this ratio to be a standard barrier of entry. You do not want to get stuck with a company that holds more liabilities than assets, do you? Number 3, debt to current asset ratio. This rating shows you how much of the company is owned by the creditors, people who lend money to the company, against the total amount of company owned by the shareholders. Graham restricts picking the stock that has a debt to current asset ratio of more than 1.10. Hence, choose the one that ends up below this benchmark. It will be unfair to the mentor if we exclude his star pupil from the successful approach. Warren Buffett obtained his knowledge from Benjamin Graham, and he also has some amazing stock-picking formulas that could help you. One of the most profound and yet a little offensive acronym you can say to someone, KISS, keep it simple, stupid. It is used very often. This 4-letter word has a powerful and witty meaning behind it. Most people like to make things complicated, just so that could be seen as geniuses. But a true mark of a genius is making things extremely simple. Warren Buffett once said in a speech that if you cannot explain to a 5-year-old boy your big plan in a way that he can understand it and convey it to his other friends, then your idea is too complicated. Trading doesn't just reveal your character. It also builds it if you stay in the game long enough. Von Biagi. Buffett's success formula began in 1950 when he invested in a textile manufacturing company named Berkshire Hathaway and an insurance company, Geico, General Insurance Co. It was a huge success for him, and it built a foundation upon which large profits and cash flow were gained. The profits were then used to acquire new stocks, and thus began a revolution that snowballed and created one of the biggest investment companies of all time. Are you interested in what those principles were? It's a simple 7-step formula. Let's see. Buffett's 7 simple stock-picking formulas. Number 1, be patient. Buffett preaches to young investors to be prepared for any opportunity that might reveal itself. Wait for your chance and grab it tight when you see it. Being reckless is a killing blow for an investor's journey. The market keeps moving, and thus some of the great companies sometimes offer their stocks for a cheaper price. You are the one who will sneak at the opportunity and own it. Invest in companies that can go on for decades and perform well. This step alone will help you build a stunning portfolio. This phenomenon is greatly explained in a quote from Jim Rogers. He said, "I'll just wait until there is money lying in the corner, and all I have to do is go over there and pick it up. I do nothing in the meantime." Jim Rogers. Number 2, buy stocks at a cheaper price. A value investor is one who can buy for less and sell for more. The trading value must be lower than the intrinsic value for this trick to work. Do not pick any stock that is already running at a premium price. The companies must have lower debts, a higher margin of safety, a higher return on equity, and should generate a lot of cash. In addition to that, it should also have a positive track record for the past decade. That should be your filter. Number 3, shatter the conventional wisdom. Break the curse of the herd mentality. Find what the market is doing and do the opposite. Be greedy when others are fearful, and be fearful when others are greedy. This motto will be with you through thick and thin. I think investment psychology is by far the more important element, followed by risk control, with least important consideration being the question of where you buy and sell. Tom Basso. Do not invest in anything you don't know. It is cool to own a share of the new company that can make new currencies, but how does it function? What is the goal? How does it work? What is safety or security? If you don't know the company, no matter how shiny and attractive the stock is, do not invest in it. Invest only in the things you know and understand. That will keep you in a better place to make a decision. Number 5, be confident with your decision. When you make a decision of buying or selling a stock, it is already backed up with your findings. Hence, do not question yourself and just do it. Do not get caught in the mirage of self-doubt or be victim to the loss of delay. Your research is complete. You poured your heart and soul into it. You know that there aren't any major errors, so stop being fearful and take the plunge. Go make it happen. You shouldn't seek validation from the market or other people. You are the only owner of your life. Confidence is not, I will profit on this trade. Confidence is, I will be fine if I don't profit from this trade. Yvonne Biagi. Number 6, invest in companies that have an edge. Being able to own a share of a company that holds a serious competitive advantage is really awesome. This company can never be outperformed because the advantage remains. If you are the first person to do something and bring it to the market, no matter how hard the second one tries, you will always be the first one. That's an advantage. If a company has a system or algorithm exclusively with them, a magic formula or a recipe that makes them who they are. Number 7, don't get attached to the stocks you own. It could be difficult to let go of something that you hold dear. Therefore, no matter what happens, keep it professional and make it your objective to stay so. Anything can happen, and the company you love so much could fall, but if you are rational about it, you'll make the right call and sell the stocks rather than sticking with it until a huge blow is incurred. It is really a simple formula, and everybody could do it. But why doesn't everybody do it? That's the exact same question Jeff Bezos asked Buffett, and he replied, it's because most people aren't patient enough. They want money fast and not slow. How to beat the market. Beating the market is a dream of every investor. Only a few people could ever do it. It's not easy, that's for sure. The key is finding the fallen stocks or a whole bunch of them and start investing. There will definitely be a few of them that can rise in value exponentially and when the market notices its intrinsic value. Your job is to notice it first and be the first one to invest and wait. It is carefully observed by many investors that most of the market-beating tips and techniques are molded into the value investing method. Use the techniques taught by greats like Benjamin Graham and Warren Buffett. Not all investments will bear delicious fruits, but most of them will be enough to suffice you for a long time. Patterns don't work 100% of the time, but they are still critical because they help you define your risk. If you ignore patterns and focus on hunches, feelings, and hot tips, just forget about achieving consistency. Yvonne Wee. I can proudly say that sticking with your own strategy is by far the most rewarding element. If you keep changing the way you make decisions, sooner or later, you will diminish your portfolio into nothingness. No strategy, regardless of how great it is, will underperform sometimes, and if you can't stay put and be patient as Buffett told you to, then you have to remind yourself why you began in the first place. Don't make rash decisions and panic over them. Stay calm and let the time do its work. It may take a few years, but your investments will give you a return. Losing money is just a part of the big victory game. Stay put. This is a point where I have to ask you this. How much underperformance can you handle? To be the best value investor in the world, your prowess should be on par with the likes of Warren Buffett, Charlie Munger, John Neffs, and many others, because the fact is you will face the scene of underperformance quite a lot. Your ability to handle it is what will keep you in the game. The greater your resolve and tenacity, the better. I'm only telling you this because most of the people who actually manage to beat the market aren't the ones who never lost money, but they are the ones who were determined to succeed. despite the odds being stacked against them. For 3 years, between 1970 to 1973, Bill Ruan was running an investment partnership called Sequoia that underperformed. While the market was compounding at a dazzling 9% return, Sequoia was only gaining 0.7%. Investors were aggravated and left the partnership, but this was a huge mistake on their behalf. Ruan was known as the man with one of the best track records on Wall Street because he consistently gained a marvelous return of 24.4% for the next 10 years. The same thing happened with Pacific Partners as well. The halt came in 1970 and lasted for 6 whole years. Sometimes the return was negative. During this, investors who couldn't handle it left, and they missed out on a staggering return of 37.9% that remained for the next 8 years. They must be so bumped, right? There's no reason for you to get all hyped and leave the game just because you are faced with a setback or even a temporary defeat. You need to stand firm and take it head on, waiting for your turn to shine. In the long run, the returns will be fantastic. Isn't it astounding that the conclusion of this thesis is, if you want to beat the market, you need to first underperform? I think it is one of the best tips I could give you in this section. Don't blindly follow someone. Follow the market and try to hear what it is telling you. Jamin Shah. The art of buying a stock is not completely 100% workable. If you only focus on the stock, you are actually missing out on the bigger picture. You must instead buy businesses rather than just stocks. Think how it would be to own a manufacturing company, a social media company, an operating system company, or being indulged in the shoe business, or taking an active part in companies that deal with biodegradable products, or try to change the way of the world. When you start to think about how the business in your portfolio is trying to impact the world and all of its existence, it will be an easier decision to make. Most of the other things don't matter much if you get this in check, according to me. Every value investor will nod with me on this one because that's where success and profit lies. Skip the absurd trend and avoid the peer pressure of investing in something you do not believe in. Your money is better off investing the way you feel fit. The only time you are allowed to sell these stocks is when they lose their values and foundation upon which you liked them. I have told you before that do not get attached to the stock of the company you buy. However, it doesn't mean that you shouldn't love it as your own. If you are passionate about the business, if it makes you wake up every day, if it is the one thing that you like about the industry, then choose that stock before you pick anything else. If my goals align with the goals of Apple to go against the status quo and build technology that revolutionizes the world, there shouldn't be any other power in the world that can stop me to invest in it. Furthermore, I also know that Apple is a profitable company, so why not? Another tip that I find really interesting is that the diversification of stocks is much more overrated today than it was before. However, there is a catch. It is true that you need to diversify your investments and cover a larger industry or business, but that shouldn't be your only goal. If you stretch yourself too thin, then the returns you gain may be positive, but it will also be quite thin. What to do then? I'm glad you asked. I recommend that you find companies that provide you with a great return. If you do, keep them in your portfolio and just try to find any that could outperform the one you already have. If you couldn't currently find any other company, then it means you already own the best out there. You must try to buy more of what you already have until you find the next best one. Do not keep all your eggs in one basket, but keep changing your eggs so you have the fresh one with the highest value. I believe that this, in fact, is the essence of beating the market and gaining exponential profits. When you know what you are doing, investing becomes fun and long-term. You will stick with it consistently and keep investing so that there is no other option left than to become successful. We've reached the final gate, and from here, I wish that you make all the right decisions regarding your money. If still things start to go south, do not get scared or aggravated. Be level-headed and learn to wait. Oh, and I just remembered that one of the best things you can do to remember things is to revise them. Since we've covered a lot in this book, it needs to be revised, or else you might forget it someday. So let's go to the next chapter, where I will summarize the key takeaways from each chapter. The final chapter before we part ways. See you there. Call to action. A quick message before we start the final chapter of this audiobook. If you're enjoying this audiobook, I'd kindly like to ask you to leave a brief review on Audible. Reviews aren't easy to come by, but they have a profound impact. So we would be incredibly thankful if you could just take a minute to leave a quick review through your Audible app, even if it's just a sentence or two. To do so, just click the three dots in the top right corner of your screen inside of your Audible app and hit the Rate and Review button. This will take you to the Rate and Review page where you can enter your star rating and then write a sentence or two about the audiobook. It's that simple. Again, just click the three dots in the top right corner of your screen and hit the Rate and Review button. Enter your star rating and that's it. Thank you so much for taking the time to leave a short review on Audible. We are very appreciative as your review makes a difference. Now back to your scheduled programming. Conclusion. What seems too high and risky to the majority generally goes higher, and what seems low and cheap generally goes lower. William O'Neill. It was an amazing journey with you, and I enjoyed it. I must say, you are a fun person to spend some learning time with. This is the chapter dedicated to helping you reiterate what we learned in the book. I will summarize the major points so that you can remember them for a long time. Value investing is the best technique to earn money and become rich in a definite proportion. Anybody who practices it is destined to become wealthy. Look at all the successful investors, and you'll find one thing in common. In the introduction, I promised you a few things that you will learn from this book, and I believe that I backed up my claim. I hope you liked what you read and are getting ready to implement the lessons and principles in your investing journey. I will go through each chapter individually and highlight the important parts for you. Let's begin with Chapter 1. Foundations of Building Wealth. This chapter covered all the basic foundational knowledge that you as a value investor might need. A collection of all issued companies where people from all walks of life and all levels, from beginners to professionals, could buy and sell stocks in exchange for money. The piece of the company you buy is called a stock or share. Owning stock is similar to being a part owner of the company. That's an awesome privilege, isn't it? By doing so, you are not only earning money, but also contributing towards the greater good of the country and its economy. Companies need money to grow, and they ask you to lend it to them. In return, they promise that when the company profits, you will also earn money with them. The market functions in a way when an investor buys a stock for a particular price and then sells it probably at a higher price, earning profits. I chose stocks because it is one of the best investments out there. Nothing else has shown such a drastic increase over the years. The market abides certain functions, like providing transparency and required data to make a decision. Establishing an efficient system under which the stocks will be priced and traded. Giving instant access to trading at all times. It must scrutinize whether the investors are abiding by the rules or not. It must have a sense of security so no one faces any form of confusion or fall victim to a scam or fraud. It must have a well-balanced ecosystem for everyone. The three types of trading include day trading, one who buys and sells the stocks on the same day. Swing trading, one who buys and holds the stock for one or more days to sell it at a higher price. And finally, the long-term trader, one who holds the stocks for a really long time. Along with that, there are different types of stocks available to purchase as well. Here they are: ownership stocks, market capitalization stocks, dividend stocks, risk stocks. Ultimate Guide to Successful Investing. Value investing is the core foundation of attaining success in the stock market world. There are often stocks that are underestimated by the market. Your job is to find those golden nuggets and add them into your portfolio. Knowing the company's fundamental status and vision could help you make a better decision. Value investing refers to getting your hands on an underappreciated stock and then holding it until the value rises exponentially. Every stock has its true value. Sometimes its values drop below their true or intrinsic value, which is the window of opportunity that you need. Buy the stock as soon as you can, and then let the time do its magic. Certain factors result in determining the true worth of the company. They are the company's financial performance, debt, assets, revenue, profits, cash flow, investors, vision, brand, need in the marketplace, a competitive advantage over their rivals, etc. You can get all the financial information of a company from its financial reports, like the 10K and 10Q. The factors undervaluing the stock are as follows: the herd mentality, major market crashes, new stocks, blundered news. Use value investing as a concrete strategy to buy cheap and sell incredibly. I believe that social media, news, peers, stock price, and everything else are greatly inaccurate. The only absolute form of true information is the company's financials, reports, balance sheets, income statement, and any other financial data. Value investors often choose based on the capabilities of a stock to generate cash year in and year out, or pay attractive dividends. Always keep cash in hand for any opportunity that might reveal itself. Never keep all your eggs in one basket. Diversify your portfolio across industries and businesses. If you've picked the right value stock, you know that you will gain success in the long term. It is proven by Buffett and anyone who followed his philosophy of investing. Focus on the revenue and cash flow of the company, because some businesses might look good on paper, but they might kill your profits. Building wealth the simple and easy way. This chapter is dedicated to helping beginners in starting their journey in the stock market world. Compounding is the most important topic in investing. Learn it thoroughly. It means the returns you gain on any particular investment increases over time. The longer you allow compounding to work, the greater will be your profits, assuming that the stock you picked is giving you a positive return on investment. The sooner you start, the richer you will be. There are a few questions you might be having, and I've answered them all in the book. Let's review and give me your answers right now for the following questions. Where should you start investing? What is the accurate amount you should start with? Which investing strategy should you use to surely become rich? Should you invest on your own or seek help? Which type of stocks to pick as a beginner? What are the different types of stocks? This chapter would be incomplete without some hardcore tips related to this matter. Hence, here they are. Look for a recurring growth. Invest only in the companies that you truly like and know that they could make an impact on people's lives. Think in terms of decades, not months or a couple of years. Be optimistic, but also be open to pitfalls and harsh decisions. Discern if the company is worth investing in by looking at its future growth potential. Find the dividend ratio of the company. Analyze the financial reports of the company to gain a comprehensive perspective about them. Buy stocks when a lot of management members are doing the same, and sell stocks if they are selling. Check out the leadership or board membership of the company. As a value investor, you won't be selling stocks often. After a decade or two, you will gain returns and dividends so high that selling a legitimate stock will make you look foolish. A robo-advisor will help you to diversify your money across multiple ETFs, which could give you a great start, but also be aware that diversifying too much is not the best policy, as it might stretch thin your returns. The magic formula is the systematic disciplinary strategy that enhances your ability to learn more about value investing. It leans towards a company's overall stock performance, providing annual returns that are sometimes higher than what the market or any other index funds like S&P 500 offers. This formula considers two major values of the stock to rank them: the stock price and the cost of capital and returns. With this, you have a quicker way to find and qualify your stocks based on the algorithm. The formula: EBIT divided by net fixed assets plus working capital. Use this formula in the manner described in the book. Greenblatt also mentioned that this formula has provided returns of almost 30%, which is astounding. Definite formulas of successful investing. The proficiency of valuing stocks is single-handedly the most crucial skill of all. It is necessary to know about the risks that you might be taking during value investing. Here are a few risks that must be dealt with to gaze your eyes upon success. Not understanding the figures. Tremendous gains and losses. Owning overvalued stocks. Inability to diversify. Flowing in emotions. The P/E ratio is the cornerstone metric to analyze and decide whether to invest in a company or not. To obtain this number, simply divide the share price of the stock by its earnings per share. GAAP, GAAP, is another method of determining the right P/E ratio of a company. It's an acronym for Generally Accepted Accounting Principles. Buying and selling decisions are incurred after knowing the true intrinsic value of the stock. I will demonstrate 7 proven techniques to help you discern the intrinsic value of the stock to enforce and elevate your investing acumen. Multiples of earnings. Discounted cash flow. Benjamin Graham's formula. Ultimate P/E formula. Net current asset value. Asset reproductive value. Earnings power value. Refer to their full meaning from Chapter 4. People are confused about identifying an undervalued stock, and hence I decided to share with you 6 distinct indicators that will help you find them. Lower P/E ratio. Lower price performance. Low price to earnings growth ratio. High dividend yield. Low market to book ratio. Ample cash flow. Achieving success with must-have metrics. Metric is a collective assessment of a group of stocks to generally verify the quality and compare it with others, to discern and invest in the best. It has been around for ages, and throughout history, people from all walks of life have used it to gain an upper hand and build wealth. In close proximity, metrics are nothing but a group of data that are assembled to create a definite result or conclusion. KPI is the widest used metrics to determine the role, track performance, achieve goals, and make informed decisions. Metrics are not only used in business and the stock world, but it is also used for bigger things like evaluating the rate of unemployment in the country, the population, GDP, and also inflation, etc. In stock, there are certain metrics that you need to be aware of. Return on investment. Compound annual growth rate, CAGR. Return on equity. Debt to equity. Payout ratio. Beta. Free cash flow. Price to book ratio. PEG ratio. Price to sales. Profit margin ratio. All the metrics listed above are used by value investors to dignify their decision. Strategies and guide in building wealth. Strategies play a crucial role in stock investing. Benjamin Graham speaks about 5 strategies in his book. They are as follows. General trading. selective trading, flipping stocks, long pull selection, bargain purchases. Did you know that the PB ratio must be less than 1.0? The PE ratio must be lower than 40%. The share price must be less than 67% than the company's net current asset value, NCAV. And the total debt should be less than its total book value. Value investing is incomplete without the fundamental analysis. It is defined as scrutinizing the qualitative and quantitative factors of a company to gain more data about its intentions, and vision is an essential component of value investing. Analysts estimate a stock's price by comparing it to the marketplace. If intrinsic value is higher than the current value, it's undervalued, and if intrinsic value is lower than the current value, it's overvalued. Some of the qualitative fundamentals that you should consider as follows: the business model of a company, competitive advantage, the board or management. Stock screening simply means analyzing the stocks. It will enable you to build a portfolio just like the great minds of our time. A few criteria include growth on EPS, ROE, ROIC, low debt, DCF, etc. This is what Warren Buffett uses to begin his screening process. Use the following criteria to judge the stock. Analyze if you can understand the product of a company, its unique selling proposition. Is the company financially free to raise prices? Is the company investing well in its expertise, its market conditions, etc.? These filters on your screener will give you a list of qualified stocks that you can then invest in. Some of the best stock screeners are TC2000, Stock Rover, TradingView, Atom Finance, Zacks and NASDAQ Screener, TradingView, TD Ameritrade, FinViz, Market Gear. Let's make a fortune. I told you before that value investors do not sell their stocks. However, there are a few circumstances in which you have no other choice but to sell. Knowing when to sell is a crucial skill of an investor. Here are a few situations under which you can sell your stocks. When you buy the wrong stocks. When you gain an exponential profit in the shortest period. Imprecision valuation. If the PE ratio increases significantly. When companies let their employees go. If you need money. When the stock performs as expected or if it exceeds expectations. When you find another stock that has higher growth potential. If there are unwanted or disliked changes. Your buying reasons do not exist. If the owned company is being acquired by others. An imbalanced portfolio. When trading volume decreases. When the stock becomes a media sensation. When stocks stop growing. Some of the worst reasons to sell your stocks are when the prices decrease or increase for a short time, or when other people are selling their stocks. Do not get involved in the herd mentality. On the contrary, you can buy stocks when they are on sale. Stocks are undervalued. Your research is complete. Elite's tips and techniques. This chapter will provide you some profound tips to help you get more for less. Value investing is the best strategy of all. You already know that. There are two types of investors according to Graham. One group or type is called defensive, and the other is called aggressive. He believed that the defensive group should invest in blue-chip companies that are valued more than $100 million or have a strong financial condition. Conversely, the aggressive group should invest in diversification and be active in research and findings. Here are additional criteria that Graham uses. Quality check and rating. Current ratio. Debt to current asset ratio. Buffett implies the keep it simple methodology. He does not like things to get complicated. He owns a 7-step formula that every investor must inherit into his or her life. Number 1, be patient. Number 2, buy stocks at a cheaper price. Number 3, shatter the conventional wisdom. Number 4, do not invest in anything you don't know. Number 5, be confident with your decision. Number 6, invest in companies that have an edge. Number 7, don't get attached to the stocks you own. Beating the market is a dream of every investor. Only a few people could ever do it. It's not easy, that's for sure. The key is finding the fallen stocks or a whole bunch of them and start investing. Stick with your own strategy no matter what happens. Ask yourself this question: how much underperformance can I handle? And try to increase that, because there will be a long halt at some times, and you need to stay put rather than make an impulse decision that you will later regret. The greater your resolve and tenacity, the better. One great tip is buying businesses and not just the stock. Be passionate about the companies you own and their values. Be passionate about them. In addition, do not over-diversify your stocks. It will stretch your profits thin. A better way is to own the best company and then try to find another that is better than that. If you do, buy those stocks. If you don't, then buy more of what you already own. I believe that this, in fact, is the essence of beating the market and gaining exponential profits. That's all for this time. I hope you like this book and that you will implement all the principles, tips, and techniques taught in it. If you do, rate this book on Amazon, and I will be glad to know that you are witnessing positive changes in your life because of this book. Use it as a catalyst to decorate your financial side and build wealth. I wish you all the best in your future endeavors. Keep value investing and keep making progress. I'll see you again with a new book. Until next time. J.D. Rams.
A gift just for you. Thank you very much for purchasing my book. As a sign of appreciation, I have a gift just for you to accompany this book. These will help you start investing in stock market and guide you the smart way. So go ahead and get it. Good luck and God bless you. Please click the link below or scan the QR code to confirm and claim your bonus e-books. Gift 1, how to get the most out of your stock options as a beginner. Gift 2, your guide to stock investing. So what are you waiting for? Let's get to it.
From the author. Hi, thank you very much for checking out my book. J.D. Rams here, a licensed mechanical engineer and a former university instructor with experience designing robotics machines used in a manufacturing company based in Japan. In 2004, I read a couple of books about the stock market and real estate and started investing in the following year. Thanks to God, I'm still here, had the chance to share my most fantastic experience in investing, which is one of the most excellent strategies of all time that will make you more money in the long run while you sleep. I have written this book and founded The Smart Investor to help investors develop their potential and teach them how to invest in the stock market the right way in the shortest possible time, which I acquired through years of experience. You don't have to learn it the hard way. To develop your full potential, please scan the barcode and join our community where you'll learn further, increase your knowledge, and get the latest update in the U.S. stock market. On our Facebook page, you can ask any questions, and we won't hesitate to answer them satisfactorily. Good luck and happy trading.
This has been The Secrets of Value Investing You Need to Know. Discover the techniques used by elite successful investors and learn how to build wealth in the long term and achieve financial freedom faster and effortless. Written by J.D. Rams. Narrated by Mark Wheeler.